And welcome to the March 2025 UCLA Anderson Forecast, Economic Outlook and Technology Conference. But there is so much going on. I'm sure that surprises you. And so we're going to be talking about the tsunami of directives coming out of Washington, about wildfires, about AI, about Silicon Beach and aerospace today. So a whole set of things, but there is kind of a unifying theme, which is what's going to happen here in California, what's going to happen with our economy as we go forward. So to start out, where do I want to start? So our program today, we're going to begin with the US forecast and the California forecast. And then a special presentation on the economic impact of the wildfires that just occurred in January here in Southern California. After that, we have a panel discussion on AI and these emerging and disruptive technologies. Then we're going to take a break, and then we're going to have our keynote, the President and CEO of Aerospace Corporation. We're going to talk about one of the growth areas actually here in Southern California, which is aerospace. So we have a really good program. And so let me begin by introducing myself to those of you who don't know me. I think everybody knows me here, but anyway, I'm Jerry Nicholsberg. I'm the faculty director of the Anderson Forecast. I'll be doing the California forecast. I lead our California team. Our first presenter is Clement Bohr. Clement comes to us from Northwest University by way of Columbia, and he leads our US forecast team. And then Ji-Yoon Lee is going to talk about wildfires. Ji-Yoon is the Mercury Insurance climate economist at the forecast. So that's the part of our forecast team that you'll see today. We also have with us William Yu, who is a co-author of the Economic Impact of the Wildfires, and Thomas Ash, who is another one of our economists who specializes in regional economic analysis, finance, and climate change, and Sayantani, who is our real estate economist, and at future events, you'll be seeing them. So the conference today is in collaboration with the Easton Technology Management Center. You see their logo up here. And as you know, things are very much in flux. Budgets are in flux. We could not put on these programs without our sponsors. And so I just want to take some time and recognize our sponsors. And by the way, listen carefully. And if you don't hear your company's name, please see us, because we can fix that. And we do want to fix that. Our principal level sponsors today are RSM and Yamava Resort and Casino at San Manuel. Our platinum level sponsors, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, Avenue Insights and Analytics, Bank of California, California Steel Industries, Hub International, Leap Development, PNC Bank, Robert Half. At the silver level, Comerica Wealth Management, Marsh McClellan Agency, U.S. Bank Private Wealth Management, Wilmington Trust. And at the bronze level, Accutive Security, HDR, Shawmut Design and Construction. And as always, our academic sponsor, UCLA Extension. And so let's see, with that, and I introduced our forecast team. We have one member of our forecast team who is unfortunately not with us. And that's Professor Ed Leamer. Ed spent 45 years here at UCLA as an educator, 17 years as director of the forecast, and it made a huge impact on a whole generation of students and a huge impact on the forecast. He really taught all of us in economics how to start thinking about economic events, how to think about data, and how to interpret that. And so in that sense, he's really with us today. A few weeks ago, we did a webinar, and the webinar was a tribute to Ed Leamer, Contributions to Economics. It has a personal part to it, but it's mostly about his impact, including 3 Nobel Prize winners who talk about how their research program really evolved because of Ed. So major impact, and Ed, we miss you. Okay, with that, it's time to turn to all of the things that are going on in the US and how do we make sense of them? And so I'm going to turn it over to Clement.
Thank you, Jerry. And I'm not sure if you mentioned, but that webinar is available on the UCLA Anderson Forecast. So please take a look at it. It's a wonderful hour tribute to Ed Leamer.
If you go to our website, you'll see it there. There's a link. You click on it. I think you'll really enjoy it. It's it's really a nice webinar, a nice tribute, but also really interesting.
Right. Okay. Well,
thank you.
Good morning, everyone. So as Jerry already mentioned, a lot has happened since our December forecast in the US and in the world. But when it comes to it, actually not as much has happened in terms of our forecast here, because we were fairly spot on in December. But the one thing that has changed is that US economic policy uncertainty just keeps on going up. Okay, so what I'm showing you here are 3 measures of economic policy uncertainty that are put together by Nick Bloom at Stanford and his colleagues around the US, specifically for fiscal policy, for regulation, and for trade policy. And what you see is that when Trump was elected in November, they just started shooting up. And after he actually came into office, it just kept on going up further, right? So there's a lot of uncertainty going out there. These are very large uncertainties. If you want to look relative to May 2023, there was a spike there in fiscal policy uncertainty because we almost had a government shutdown there, if you remember, between McCarthy and Biden. That we managed to not have a shutdown last minute. But still, that level of uncertainty is much lower than the uncertainty we are facing now. Right? Now, as I mentioned, we were fairly accurate in the forecast about what has happened so far in terms of economic policy. Back then, we forecasted that there'll be 25% tariffs on Mexico and Canada, along with 10% on China, or an additional 10% on China. We expect the extension of the Tax Cuts and Jobs Act. That's still very much on the table and expected to happen. And then we forecasted that there would be deportations that would ramp up to be about 1 million a year starting in 2026. And though we don't have much data on what's happening with deportations right now, there's very little they're putting out, but what they have been putting out shows that they have significantly ramped it up. They're going at about Obama-era levels of 300,000 to 400,000 people deported a year. And there's expected to come in more funding in order to scale that up more. So it's looking like this forecast is still holding up on all of these accounts. But there's a lot more coming, or should I say there's a lot more maybe coming, right? I mean, and the reason why I have question marks along all these is because we don't know what's actually going to happen, right? We just know what there's been stated. So with tariffs, we have seen another 10% on China. They're expecting another 25% or 25% on steel and aluminum starting next week, but they've also talked about tariffs on cars, chips, pharmaceuticals, lumber. They're talking about 25% tariffs on EU now going into effect sometime in April. This concept of reciprocal tariffs. They've talked about copper, there's almost more every day. And when it comes to fiscal policy, there's also a lot of uncertainty about how this tax cuts bill is going to turn out and what it's going to look like. There's different bills trying to be pushed through the House and the Senate. And they range from increasing, border and defense spending between $200 and $600 billion over 10 years. There's talk about, 3.7 to 4.5 trillion in tax cuts, 2 to 11 trillion in spending cuts. And then we have the whole issue of funding the government that has a funding deadline next week. So, and we don't know whether there's going to be a shutdown or a continuing religious resolution and what's going to happen there. So lots of uncertainty on the fiscal side as well. And then we do have another new part that we were not expecting back in December, which is the real impact that the Doge has had right from the get-go, right? And so far they've had about 100,000 employees that have been, left the government either from buyouts or federal firings, but the intentions are those to be ramped up to a significantly higher level where they claim they want to reduce the workload or the workforce by about 10 to 15%. So in this talk, I'll talk a lot about the fiscal policy uncertainty first, then we'll talk about the tariffs and the trade policy, and then we'll end with the US economic outlook over the next couple of years. For fiscal policy, we both have uncertainty in the short run and in the long run. As I mentioned, we have the funding deadline next week, and then we have these tax bills, which are going to take longer time to weed out. And when we look at the tax bills, I first want to talk about the House tax cut bill, which is the most explicit one yet. And you can say that's the Republicans' plan A as of now, where they want to put through at least $200 billion in border and defense funding. They want to cut taxes by $4.8 trillion, which is much more than just extending the Tax Cuts and Jobs Act from 2017. And then they want to reduce the federal spending by $2 trillion. So this bill here in and of itself would increase the federal deficit by $2.8 trillion over 10 years. And there is a lot of uncertainty about whether they're going to be able to get this, or I should say doubt about whether this bill can be passed, because the Republicans only have a 3-seat majority in the House. There's a lot of hardliners that don't want to see any increase in the fiscal deficit. And there's also a lot of moderates or people who come from areas that rely on funding from places like Medicaid and SNAP. And 1 trillion of those 2 trillion in spending cuts are completely from Medicaid and SNAP. So there just doesn't seem to be the amount of people there in order to get this bill passed. And so that turns it to the Senate's bill, which is the Republicans' Plan B, which is really a bill where they can sort of kick the can down the road and deal with a lot of these issues later. So they want a quicker bill where they put through this increased funding for border and defense, and then they want to pick up a later bill where they pick it up again and they want to make the Tax Cuts and Jobs Act permanent. That's the 3.7 trillion tax cut. And then they want to supposedly reduce the spending by 11.5 trillion, but that is completely unspecified. And as I mentioned, there isn't even appetite for a little bit of tax cuts. It's very unclear where they want to go with this. But as I said, what they're essentially doing is they're just kind of leaving the door open for basically anything to go on, right? So even if that second bill gets passed, it doesn't really tell us much as of now what's actually going to happen. And that's what I'm trying to show you in this picture, which are the projections for that bill about what's going to happen over the next 10 years in terms of the debt to GDP in the US. And what you see is that in 2034, the range of what's going to happen could be from that the debt to GDP could be at 99%, or it could be as high as 130%, right? That's more than $11 trillion in difference. We don't know what this bill is actually going to be in between that range. It could very well lead to an increase in the deficit as well. And so there's also doubt whether they're going to be able to get that passed, right? And that leads us lastly, what I have in the bottom left corner, which is the more short-term uncertainty about funding the government next week. They need to get Democratic votes on board to pass it through essentially both chambers, because a lot of the Republicans hardliners do not want to increase spending or just have a flat budget increase with the continuing resolution. And so they have to work with Democrats, and Democrats right now are not very willing to work with Republicans because they don't want to pass a tax bill, which they then say didn't really matter because the Trump administration isn't really, behaving as if or following the legislation of that tax bill and funding whatever they want, irrelevant of what that tax bill says. And so that would lead us to a government shutdown. So there's a lot of uncertainty about what's going to happen even next week, as well as throughout the rest of 2025 in terms of fiscal policy. Okay, so as I mentioned, there's very little appetite for more spending cuts. The Republicans have already promised they're not going to touch Social Security and Medicare and defense. And they also don't want to touch Medicaid, it seems like. But at the same time, the US debt is reaching unsustainable levels where it's just going to start snowballing and becoming larger and larger on its own. And so what I'm showing you here is the reason why that's the case. What I'm showing you is the cost of servicing the federal debt, that is just paying off the interest payments on those loans that we owe the rest of the world that carries these treasury securities. And what you see is, and the reason why this is going to snowball is that to pay these servicing costs, we're just going to have to take out more debt to pay them off. and the amount of debt we have to take more, we have to extend to pay these off is so large that it's just going to add in and make these costs higher and higher over time, right? So we have this rapidly growing, or not rapidly, but gradually growing US debt. We don't have much interest or appetite for spending cuts, yet they're really trying to put through tax cuts, right? Tax cuts right now, right? So it seems, not just fiscally irresponsible to be talking about large tax cuts right now, it's almost fiscally destructive. And so there's, again, a lot of uncertainty about what's going to happen. But what about Doge? We haven't talked about Doge. Perhaps there can be some savings in Doge, right? And our perspective here at the forecast so far is that it doesn't look too promising. First of all, if you look at federal employment, that's a very small part of government funding. I just want you to look at the last bar here for 2020 in this figure, which shows this amount of employees directly hired in the US federal government, as well as adjacent to it. So as you can see, there's about 2 million people directly hired, which that's the dark blue bar, another 1.5 million in the military. And then the largest part are the government contractors. So that's private firms that are paid by the government. And that's another about 5 to 6 million people, right? So as I mentioned earlier, their intention of Doge is to reduce the federal workforce by 10 to 15%. So if that's just federal employees, that would be layoffs of around 200,000 people. But if it extends to the entire government, including contractors, that could be, as high as 1 million people that are going to be fired. And so we don't really know where we're going to end up in between there, right? If it's just 200,000 people, that's still a lot, but from an accurate macro perspective, that's 0.1% in employment, so not a huge increase in unemployment. But on the other hand, if we get 1 million layoffs, that's a 0.5 percentage point in unemployment, which is when we begin, as forecasters, begin worrying about what that's going to look like for the macroeconomic picture, whether that's going to spill in and create a larger indirect effects in the economy. And then there's the other part of Doge's operation, which is about defunding a lot of these contracts and minimizing expenditures. And there, all we can say is that so far, it's very unclear if they've had any success at all, right? They have claimed to cut some $60 billion. They showed a wall of receipts for 16 billion of those. And we could only really verify that 2 billion of those were actual savings or cuts in spending. And the issue was that the rest of those 16 billion were either, just incompetently, incorrectly accounted for, but they're also all biased in one direction. So they're also very misleading, and it seemed intentionally so, right? So again, so far it seems like they've had very limited success, but it's also very unclear. We just don't know much on this side, right? And then there's the question of legality, right? A lot of this might go overturned in court. We just saw this morning, actually, the Supreme Court came out and said, no, you're not allowed to defund these $2 billion in foreign aid, right? So a lot of this is going to also, could potentially be overturned in court over the next year or so. Okay, so turning to tariffs. Here I've listed all the tariffs that have been proposed to be incoming over the next year or already have been implemented as part of this administration. I'm not expecting to read them all. They're very diverse. There's a huge array of different tariffs there. They're also very equitable because a lot of them are put in the name of fairness as the reciprocal tariffs, and they're very inclusive. We're touching all countries in the world in terms of those. So these are really the Trump DEI tariffs, okay? And for this forecast, it makes it very hard to predict what's going to happen, right? So what we have in the forecast going forward is very similar to what we had so far with the tariffs on Canada, Mexico, and China. And we've basically kept it there because there's already discussion about whether these the Canada-Mexico tariffs are going to be, reduced or minimized or overturned again or paused. There's already been some discussion there. And so if they are, it's probably pretty certain that some of these other tariffs are going to come into effect later. And so there's going to be a similar overall impact, right? And so what does this mean? Well, for the forecast, this means that the average tariff rate is going to rise to the level that I'm showing you here. This is the average effective tariff rate in the US over the last 200 years. And what you see is that it's going to increase moderately. This whole gray bar is the range of uncertainty about where it could potentially end up, more or less. And what you see is that we're sort of in the middle bottom half of that, which looks fairly moderate. Now, back in December, when we put out this forecast, that looked very aggressive, right? Now it looks moderate. Maybe this is too moderate. But this is still a very high level of tariffs, even though it looks small relative to what we had in the 1800s. Okay, so all you have to do is look at the last time we had this level of tariffs. That was back around 1930 during the Smoot-Hawley tariffs. And what the Smoot-Hawley tariffs led to was a large trade war, which was very destructive and contributed greatly to the Great Depression. Okay, so those were not. We're not at a very light level of tariffs right now. And I'm showing you that right here. So in light blue, we have the level of exports for the US in the 1910s, 20s, and 30s. And in dark blue, we have the imports. And over here in the black bar, that was when the Smoot-Hawley tariffs were implemented. And you see that both imports and exports just shrunk. Like world trade just kind of collapsed in this trade war. And it was very economically devastating to the countries that were involved. Next, I want to give you guys an example of the negative effects that tariffs can have. Tariffs that are supposed to go into effect next week are steel and aluminum tariffs. And we have a very good understanding of the effects of steel tariffs on the US economy, right? And relative to other industries, steel tariffs, when they go up, that has a very large negative effect on other manufacturing industries in the US because nearly all manufacturing industries use a lot of steel in production. So when steel tariffs go up, that makes it a lot more costly for all the other industries to produce their goods. And that's exactly what we see here from the analysis of the Bush tariffs, which were put in early 2000. This is a great analysis because the Bush tariffs were very clean. They raised only steel tariffs. There were no other tariffs going on. There was no trade war or retaliation in response to them. And so we could very cleanly understand the effect of them. And what you see is that there was a large decline both in exports and in employment, which peaked at a reduction of 250,000 jobs in other manufacturing industries as a result of these tariffs. Right? Now, tariffs can also have a large effect on the industry itself that they're actually imposed on. And so, for instance, the CEO of Ford Motor Company came out and said about a month ago that the Mexico tariffs, or equivalently some car tariffs, would essentially blow a hole in the US auto industry. Okay, and the reason for that is that the US auto industry is very integrated with Mexico and Canada. There's a lot of intermediate inputs that cross those borders many, many times. The number that's thrown around a lot is 8 times intermediate goods crosses these borders for the production of one car. Every time that border crossing happens for this import or export, they're going to be tariffed. And that's just going to compound and make production of automobiles or cars just completely uneconomic. Okay. And here I'm showing you a little bit of information on that. If you take an average car that's imported from Mexico to the US, almost 40% of the value of that car was actually produced in the US, right? So that tariff on the Mexican imported car is also a large tax on domestic producers which produce those imports, right? If you look at Mexican production, about half of the value of those cars, this is where the number comes from, was produced in Mexico versus outside. And of that 50% approximately that was foreign produced, 74% of that came from the US, right? What Trump is so worried about is this 3% from China. It's a very small number. Yeah. And this is happening at the worst time. Like this, China has over the last 4 years exploded onto the scene. They've become the largest exporters of cars, the largest producers of cars in general. These are both combustion engines and high-tech, EVs, and they're rapidly taking over the world. We're not seeing it in the US because we basically shut them out of our market by imposing 100% tariffs on them. But the rest of the world is rapidly being, overtaken by Chinese cars that are very great and cheap. And meanwhile, in the US, we want to blow up the auto industry. That is a very bad time to do it. And that's another reason why we find it very hard to believe that these tariffs are really going to stay into effect, right? Because these tariffs are going to be so destructive and so damaging that it's hard to believe that they're going to be permanent. But, we'll see. So that takes us to the US economic outlook. So as I mentioned, our forecast is actually not so different from what we had in December because we fairly accurately predicted the policies so far. We're going to see tariffs are going to be boosted and higher at around 3% over the next couple of years. In 2025, it'll mainly be due to tariffs, and 2026 will be due to deportations. I did not have enough time today to talk about deportations. I'm sorry, but there's a lot of stuff going on. And next thing is that will the Fed lower interest rates? So back in the fall, we were all very optimistic. Interest rates were being cut by the Fed. Inflation had come out. The labor markets had cooled, and things were looking up. And they had also put in 4 interest rate cuts for this year in 2025. We came out in December and said, no, the U.S. economy is actually looking pretty robust still. We should not expect this level of rate cuts. And we said there would be 1 rate cut. And that is now the market consensus. But now we're going to say there aren't going to be any rate cuts. Okay. In our forecast, we have the federal funds rate fixed over the next 3 years. And don't get me wrong, it's not because in 3 years' time, the federal funds rate will be at 4.25 to 4.5%. But there is so much uncertainty in both directions where this rate is going to go that we cannot make a credible judgment where it's going to be in the future. Okay. So on the downside risk, why rates would fall is very different. It's not lower inflation. It's actually due to a drastic weakening of the economy, right? If the economy gets too weak from these destructive policies, the Federal Reserve may have to lower rates to boost the economy. On the upside risk, we're looking at more inflation, right? And if this inflation gets too high, they may have to raise rates to dampen economic activity and hopefully pull that back. And there's also worrying signs that inflation expectations are becoming unanchored. So here I'm showing you inflation expectations in blue for 1 year ahead. And there you see a rapid rise. That's to be expected. We're expecting tariffs to come in over the next year. Inflation is going to be slightly higher. But what's very concerning is this red line, which shows a spike up in inflation expectations over the last 2 months. Now notice, even back during the pandemic in 2022, when inflation was raging, it was flat. We've had faith in the long run, inflation will come down. And now we're at a higher level in these expectations than at any time during the pandemic, right? So this is just 2 data points. It might be a blip. Other inflation expectations are not showing this, but it's a worrying sign. We're keeping a close eye on it. Lastly, the GDP forecast. Over the next year or so, year and a half to 2 years, GDP growth is going to be slowed. As I mentioned, there's a lot of uncertainty. This may be too moderate. There could be a much more devastating impact. And this is mainly from tariffs, deportations, DOGE, high interest rates. Uncertainty is something I haven't spoken about, but even this presence of this uncertainty is very damaging. When there's this level of uncertainty, firms stop hiring. They're going to wait it out. Firms start investing. They're going to wait and see what happens before they're actually going to engage. There's a large option premium for waiting. And so far, this talk has been very negative. So a little bit of positive. There is, some upside going into the further future, and we are forecasting very robust GDP growth in 2027. Remember, going into 2025, we had a very strong economy. And where is this going to come from? Well, there's a lot of different contributors or potential contributors. There's artificial intelligence. There's smart deregulation. I say smart because you could also imagine a lot of destructive deregulation. And there's also FDI, foreign direct investment, and domestic investment, right? Like we saw TSMC yesterday come out and say, look, they're going to invest another $100 billion in Arizona in manufacturing facilities, produce chips. We're going to have, a lot of the infrastructure and manufacturing facilities come up from the Infrastructure Act, from the CHIPS Act. And so this is all going to boost growth in the further future. And then we could hopefully see lower deficits, but, we could also see higher deficits. We don't know about that. So to conclude, the economy was very strong going into this administration, but now tariffs, deportations, DOGE is here, which is going to weaken growth in the short run and raise inflation. But the uncertainties are huge. Things could be slightly better. They could also be much worse. And with that last point, I want to mention that we are doing an analysis and we're going to come out with a report. So look out for that, where we're going to talk about, there is potential for things to align in such a way that we could see a recession, and not just a recession, but one with high inflation, which is called a stagflation. Okay. Now that's not what we forecast. We still don't see that as the most likely case, but it is worth exploring and putting out there that there is potential for these policies to all come together in such a destructive way. Yeah. So thank you.
Thank you for that optimistic outlook. And so now we're going to turn to California, and the way in which we do the California forecast is we start with the US forecast. And so you have all of that uncertainty, and then look at the things that are a little different in California that gives us a differential for California versus the US. And of course, as we've been talking about all morning, it's about trade wars and deportations. This picture on the right was the last big deportation of agricultural workers in California during the Eisenhower administration. So those are kind of the major things. And our roadmap for today, I want to talk about GDP across states. How's California doing? And then we're going to go to various sectors and see what are the impacts of these policies and what's been going on in California by sector. And then we'll go to the forecast. So just to start out, what you see on the upper left-hand side is GDP growth rates, and that's going from the fourth quarter of 2023 to the second quarter of 2024. So these are the large states, and over on the right-hand side in the light color, that's the US. So these are the large states, the ones that actually impact GDP growth rates, growing faster than the US. And you look all the way over to the left, and of course, California's in gold, being the golden state, and it's the fastest growing state. Now, depending on what period of time you pick, it may be all the way over on the left, it may be a little bit to the right with some states growing faster. But the point is, California typically grows much faster than the US. And it has been. But if you now look over here on the right-hand side to these numbers, you see that all of the action in 2024, and by the way, we only have numbers yet through the third quarter of 2024 for each state. But all the actions in the first quarter. After that, California is growing at the same rate as the US. So the growth rate's slowing down. I'm going to show you some employment numbers shortly, and the employment numbers are gonna basically indicate that this slowdown in the growth rates has not stopped through the fourth quarter. And if you look on the bottom here, California's unemployment rate in December is 5.5%. It's 1.4 percentage points higher than the US at 4.1. The US just ticked down to 4.0, but this is like months to like months. And that 1.4% is something we want to explore. What's going on here in California that gives you the higher growth rate? Now, one thing is that California is a much more entrepreneurial state than other states. That's going to give you about a 0.4 percentage points, which means we need to look for where is that other 1%? What's happening there? What does that tell us about the future growth and future evolution of the California economy? So to start off with, I want to look at employment numbers. You see two lines on here. One is a blue line on top and a red line on the bottom. The blue line comes from something called the Household Survey. It's a very small survey. In California, it's 5,500 people in an economy of 40 million. So very small survey, but people are asked by their domicile. So these are people who are actually living in California, whether they're working, whether they're looking for a job. And this is where we get our unemployment numbers from. And what you notice about it is that that blue line is not back to its pre-pandemic peak, right? Now, the US collects this for all states, and there's a benchmark revision. The benchmark revision for the US really boosted that measure, and we're expecting an increase here. And the reason why the aggregate number for the US was too low was an undercounting of immigration. And of course, California gets a disproportionate amount of immigration, so you can expect that really to come back up and really restore that difference between the two. The red line is a survey, a much larger survey, and a much better metric for what's happening in labor markets. And the red line is payroll jobs, where the jobs are. So we want to say, well, what's different about that? Who's in the blue line, not in the red line, who's in the red line and not in the blue line? So if you look on the right-hand side here, in the blue line, that includes self-employed. And that's going to be important in that unemployment differential. It includes gig workers. It includes it includes family members who are working in a family business. Okay, and it includes farm workers. And you can see there's a couple little dips where we have these rainy winters. And if you remember driving through the Central Valley, new lakes are appearing, and you can't grow food in those lakes, right? So those are the dips that you see there. In the red, what you have in the red, which is not in the blue, are remote workers. So if a tech worker has a job in San Francisco, but lives in Boise, they're in the Idaho labor force. And they're considered employed, so they're in the Idaho blue line, not in the California one. But since their job's in San Francisco, they're in the red line. So that's remote workers. And what else is in the red are undocumented workers who are using false documents. And so their employers are reporting them as being payroll employees, right? But if they get a call from the government asking them if they're employed, that would be the blue line, they're obviously going to say no, of course not. And so that's the difference there. And we want to explore that, first with that 1.4%, how unusual is it? And if you look back in time, we've got end of the Vietnam War, we had that. End of the Cold War, the housing bust, California had a much more acute speculative building. And during COVID, California had much more severe restrictions on mobility than the US average. And so then we go over the right-hand side. We want to break that down and see what is happening in California. So we're going to look at this by sector. And so this is by sector. This is through all of 2024. We don't have January numbers yet. But if we start on the right-hand side here, that's durable goods, and that is primarily manufacturing of computers and electronics. So I'm going to talk about that. The next one is farm, and farm is going to be impacted by deportations, right? So that's not going to be a growth sector here. In fact, we may get contraction there. Next is non-durable goods, and that's where food processing happens. So if you don't have the food, you don't get the processing. But also this is slaughterhouses and the like, with a high proportion of undocumented workers. And then we get construction. That's going to be affected by deportations, particularly residential construction. So we're going to talk more about that. Then I don't want to go there yet. Then next we have the next two sectors are actually tech sectors, information and professional scientific and technical services. So we do want to talk about that. In the national forecast, we had really an increase in technology, and that was boosting growth rates in the out years. So we want to look at that, but information also includes Hollywood. So you probably didn't know, but Honora is information. Is there. So we want to talk about that. That's actually going to be really, really important. Now, on the left-hand side, what's been driving growth in California? Well, we get healthcare. That is going to be impacted both by a decline in Medicaid and by immigration policy. If you think of home healthcare, highly dominated by workers who are immigrants. And then we've got education. We're going to talk a little bit about that. Temp workers. We've got what was this? Leisure and hospitality. A high proportion of immigrants in that sector. And then tariffs are going to affect logistics. So we want to talk a little bit about that, and retail trade. And then a small sector, which is other services, personal care services. So if you look at this picture and kind of think about it, what you come up with is the things that have been driving California growth don't have legs. They're not going to drive the growth in the future. We've got to look to kind of the right-hand side, durable goods manufacturing and tech. if we're going to get growth in California going forward. So let's dig into these sectors. This is manufacturing. Manufacturing has been growing in California. You see the fall off on the right-hand side, and that fall off in manufacturing is due to the closure of a number of factories. The truck factory in the Inland Empire, some computer and electronics factories in Sonoma County, for example, and kind of throughout the state. But because of the CHIPS Act and the Inflation Reduction Act, we have factories that are being built, throughout mainly inland California, and they're going to be opening up in 2025, late 2025, 2026, and 2027. So we're actually going to get growth in durable goods manufacturing. Now turning to tech, we don't really have a tech sector, but we have two very tech intensive sectors. And this is one of them, professional and scientific and technical services. And you see the tech layoffs, and then it flattens out. And there was a recent announcement of layoffs, Hewlett Packard. And so what made the press was Hewlett Packard is laying off. What didn't make the press was they're also hiring. So one part of the company is hiring, the other part is laying off. This is just restructuring. And, with the administration's new policy of relying on tech with a shortage of labor due to deportations, it's going to be a lot of pressure here for increases in tech employment. And the other one I wanted to show you is just specifically computer tech. It gives the same pattern. Now, one thing that's kind of important, if we're going to get a lot of growth in tech driving the California economy, is we need the people to do it. And that means we need H-1B visas. The closeness of California's tech industry with the new administration kind of suggests that we're going to get that. So we're going to have deportations, but we're also going to have more immigration, and we've kind of built that into the forecast. So that sector we're expecting to grow. Now a turn to information and Hollywood, and the graph that you see here, this is payroll employment. You have to multiply that by a little more than 2 because so many people who work in Hollywood and film production are independent contractors, right? And you can see that it's kind of flat, there's a little bit of a trend. And then we get that big bump, a surge with all of the streaming content. When you go on your TV and you look at it and you see so many choices that you turn the TV off, right? That's a big bump there. And that's an unsustainable business prospect for the people who are producing that streaming. We know that that industry is contracting. You see the contraction here on the right-hand side, and the gray area are the 2 strikes. And, some of the finger pointing is going, well, this is because of the strikes. But look before the strike. This was happening before that, as you get this consolidation. And usually when you have a labor action, you get a buildup. You get some stockpiling because these are anticipated events, right? You don't see that here. And then it kind of flattens out. Now, there is some question about runaway production going to Toronto or to Atlanta or other places. There's a bill in the state legislature to provide more subsidies to kind of create a more equal playing field. So that flat line there to the right of the strikes, that may move up a little bit, but probably not much. But what's important here is this big drop of that 1% differential in the unemployment rate between California and the rest of the country. Half of it's right here. And so, in thinking about that unemployment rate, yes, this is problematic. These folks are going to have to look for work in other sectors, but it doesn't indicate sort of a real contraction, sort of an ongoing contraction in the California economy. Now turning to logistics, this is throughput in our seaports. The top line, which has a different scale than the bottom 2, is the massive Southern California ports. The bottom 2 is Port of Oakland and then the Puget Sound. And you see, there are a couple of things I want you to notice. If you looking at the red line, move your eyes from left to right. And as you're going left to right, you see this trend, this upward trend. You don't see the impact of the 2018 tariffs. And those tariffs were on China. And so William Yu and I have written about this, that was what was going on is, yes, the growth, we're not having the growth in trade with China, but it's being made up by a growth in trade with Southeast and South Asia. Okay? And so with the new tariffs, we're expecting at least some of that to happen. But as Clement showed you with his long menu list, there's a lot of uncertainty there. But what you see is the Twin Peaks here, and that's when we were all at home on Amazon during the pandemic, buying goods, and then it drops off because of threatened labor actions from the railroads and from the ports, and then we're at record levels now. We're not expecting that trend to continue, and a worrisome sign is the other two West Coast ports are not really back to pre-pandemic levels. All of the action here is in the Southern California ports. When we turn to air cargo, that's on the left-hand side, that's LAX, the top line is imports, the bottom is exports. We're not getting really an increase in exports because, as bad as we think the US economy is so much better than the rest of the world. So we don't get those exports, but we do get the imports. And now it's kind of flattened out. One of the reasons why we're not getting a lot of additional growth there is a capacity constraint. And as additional flights are added to China, we're going to get that belly cargo space, and we have the capacity to have some growth here. But a worrying sign is on the right-hand side. These are all of the airports in California, Southern California and Northern California represented there. And if you look over on the right-hand side, that's down. And so it's a worrying sign that the amount of goods that are moving by air through California's ports, domestic air cargo, is not only not increasing, but it's decreasing. So that's something that we're a bit concerned about. What is that signaling? So far we don't know, but that's one of our worrying signs. And then we turn to housing and which impacts residential construction. On the upper left-hand side, this is not going to be a surprise to you. There's no inventory. And in fact, due to the wildfires, there's less inventory now than there was before. And sales of existing single-family homes is at depression levels, and it's just not going anywhere. On the right-hand side is the Case-Shiller Price Index for San Diego, Los Angeles, and San Francisco relative to 2016, and you see prices are high. And so when you have limited inventory and high prices, that should lead to a building boom, right? But now look at the right-hand graph. Those are permits for residential construction, and there's no building boom there, right? There are a couple of important issues. One is the uncertainty that we've been talking about all morning. Another is high interest rates. And the expectation that building materials costs are going to go up with the tariffs. But another is a capacity constraint in labor. So that's what the left-hand graph is. If you look at where we are today in the amount of payroll employment in residential construction, except for the speculative building boom, we're all the way up to where we were before. And that, in spite of the fact that the state has passed all of these laws to make it easier to build in California, we've run out of construction workers, right? And that's going to be a constraint going forward. And so construction is not going to be a big driver of the California economy. And then two other sectors I want to briefly mention. You saw that education, increases in employment in education is one of the drivers of the California economy. On the left-hand side, that's K-12 enrollments. They're down. With deportations, they're going to go down even further. That's not going to be a factor. On the right-hand side, these are gig workers. And there are two things happening with gig workers. One is we're not having as much delivered to our homes as we had during the pandemic. And the second is a number of gig workers are now being reclassified as payroll employees, which raises the cost to the employer. And so they're hiring less and they're kind of shrinking that workforce. So these are not going to be growth sectors. So that brings me to this question, which you've probably been asking all morning, which is, how do we make a forecast with so much uncertainty? And so what I wanted to do was find someone who's really smart, who had no political skin in the game, and say, how do we make that forecast? And I found someone, and here is the answer. But grandchildren are great, but we do have to make a forecast. So given all of that and this uncertainty with the US forecast and the California forecast, with that kind of uncertainty, we really have to watch the data as it comes in and you know, kind of be open-minded as to where this is going to go. But we have manufacturing, finance, and tech recovering. Agriculture and construction is a big question mark. It really depends on deportations and immigration policy. So we've got slower growth in 2025 and slower growth into 2026. And then it starts accelerating as we get increased demand for labor-saving technology and software and that assumption of additional H-1B visas. And we have kind of all of the caveats, all of the risks that you heard about before. So just some numbers and a couple of things I want to point out. The unemployment rate, we're expecting to go to 5.9% in California before it starts declining, but declining kind of slowly. And if you look on the bottom, home building permits. Okay, so the housing stock in California is now smaller than it was before, and 100,000 this year. And then 112,000 up to 127,000. You know, kind of the notion that we're going to build our way out of the affordability issue in California is just not going to happen unless we somehow find a lot more in the way of construction workers. And so that was all gloom and doom, but this is California. Okay. Now we're going to talk about wildfires, and it's over to you.
Hi everyone. So as we examine California's economic outlook, recent wildfires in Los Angeles area this January is a reminder of how financial challenges this disaster can bring to the state. So let's take a closer look at the economic impacts of these recent wildfires on the California economy. So a series of destructive wildfires happened in Los Angeles area, but most of the damage was from the two largest wildfires, the Easton fire and the Palisades fire. The Easton fire was closer to urban areas, including Altadena and part of Pasadena. So it destroyed more than 9,000 structures and caused a lot of fatalities. As you will see in this figure, there are like more impact on middle-income homeowners. The Palisades fire spread through the Pacific Palisades, Malibu, and part of Topanga in Pacific Palisades area. It has less impact on destroyed homes, but that is closer to the ocean, and it happened in a coastal region. So that raised environmental issues because debris from the burned area can be washed to the beaches and have a negative impact on marine ecosystem. So what we do in this report is that we use data from past wildfires and our metrics to provide estimate for the insured losses, total property losses, and the losses in annual GDP in the LA County. As of today, some major insurers, including State Farm, Fairplan, and Mercury and Allstate, they have released estimate for their expected losses due to the fires. We added up these numbers, and based on their shared market shares, we estimate that the insured losses will be about $45 billion due to the LA fires. However, in addition to the insured losses, there's also uninsured losses and a substantial cleanup cost and damages to infrastructure such as roads and power lines. As of today, the government has not released the official report for numbers for the total capital loss. So we look at the past wildfires that happened in California to estimate the total capital losses. So we collect the data on the total median home value and fully insured losses due to the past wildfires. And we calculate the ratio of fully insured loss to total median home value. The average number is about 2.2. And we also know that the weighted median home price due to the Palisades fire and Easton fire is about $2.7 million. So we arrive at a number that the lower bound will be about $76 billion, and the upper bound for total capital losses will be about $131 billion. So because wildfires can, make affected areas less attractive to home buyers, and that could have a negative impact on home values in the affected areas. So what we do is that we look at how home values changes after the past wildfires in California, including the Thomas fire that happened in 2017, the Thomas fire and Camp fire and the Woolsey fire. So the red line in this figure indicate home price index for wildfire affected areas, and the blue line indicate home price index for the surrounding metropolitan regions. As you see that for the Camp fire, there's a huge drop in home price after the wildfires, and it never recovers. However, if you look at the home value after Thomas fire and Woolsey fire. By the way, Thomas fire and Woolsey fire share some similarities with the Palisades fire in terms of location and high property value in that regions. So we see that there is like a little drop or the home value subdued for a couple of years, and then in the long term, there's still a significant increase in home values. So historical trends as we study from the past wildfires suggest that home value may either decline or subdued for the next couple of years, but we will see an increase. And in areas with nice ocean views, such as Pacific Palisades, home values could continue to rise over the long run. So wildfires may have an impact on housing affordability because they destroyed so many housing stock, especially the Easton fire that happened in Altadena areas. So that can exacerbate the already critical issue of insufficient housing supply. And in addition to that, insurance costs in the affected area may see an increase in the following years. That can also add to the housing affordability issue. So beyond the immediate destruction of homes in the affected areas, impact of wildfires can also translate into different parts of the economy. So because business may shut down during the evacuation, and they also can have an impact on local employment and local business service. So people may move to other areas after the fire, and that can impact the county level GDP in LA County. So what we do is that we use data on historical fire perimeter in California and county level GDP. So as you see in this figure, we collect fire perimeter data from 2000 to 2022. We know exactly where the wildfires happened and when that happened, and we link that information with county level GDP in the same year. So we conduct a regression analysis, and here's our findings. We found that wildfires have a negative impact on most sectors of the economy. So in this figure, the central value of the error bar indicates the estimates for wildfire impacts. And error bar means the 95% confidence interval of the estimate. So if the error bar is different, doesn't include a zero, it means the impact is statistically different from zero. So you see that wildfires have negative impact on administration, utility, education, health, transportation, art and entertainment, accommodation, construction, wholesale, manufacturing, and the real estate sector. But we didn't identify statistically significant impact of wildfires on finance, professional, retail, agriculture, other services, information, mining, and management sector. One potential reason for that is that these sectors, there may be more flexibility for workers to work from home and have less impact on labor productivity. So interestingly, we find that if an additional percentage of population is exposed to wildfire burned areas in a county, county level GDP in the same year will be down by about 1.2%. So due to Palisades fire and Easton fire, about 0.4% of population in LA County is exposed to wildfires. So if we multiply 0.4% by 1.2%, so there will be about half percentage reduction in county level GDP this year. And that is about $4.6 billion. So for the, as you know, like wildfires destroy buildings, and that can boost the construction demand. However, reconstruction may not happen in the same year. So the construction sector for this year will be down by about 9%, as we identify from our study. So here's a summary of the key findings from our report on the economic impacts of wildfires in LA County. So we found that total property losses will be between $76 to $131 billion, and insured losses between $35 to $45 billion. We expect that the housing affordability issue will be more severe in LA County, and we also predict that there will be about half percentage reduction in county level GDP this year. That's about $4.6 billion. Thank you.
So we have, so we I can speak louder. So we have time for a few questions. And so if you have questions, we have microphones here. Oh, there we go. We have microphones here, and then we will turn to our panel. Or did we answer all your questions? I think we raised more questions than we answered today. Any questions? Yes. What do you think the results of the really stagflation in terms of both the California and the US? Inflation going up, going down. Okay, so the question was, can we comment more on stagflation? And I'll turn it over to Clement.
Thanks. So right now in the forecast, we are predicting a rise in unemployment, a decline in GDP, and a rise in inflation, but not to the points where you would call it a stagflation, a deep recession and inflation being persistent at a high elevated rate. As I mentioned in the end, there is a potential outcome where all these policies come together right at the same point, as well as in their most extreme form. That would certainly put us in a recession. And a lot of these policies will end up being inflationary. So you could call it a stagflation. It is a question whether that inflation is going to be persistent. For instance, the tariffs are not going to lead to a persistent increase in prices, right? But a one-time increase in the prices. So to make it persistent, what the Trump administration would also need to do is to start toying with the independence of the Fed, which they already have started doing in some of their executive orders, where they want to have more control over these independent agencies, right? And so that is concerning and could contribute to it. But so far, they seem to have not put their hands on the Fed. And so let's hope they continue not to do that. So there is certainly a potential future where we could see something like that. But as of now, we would consider it small.
Yeah, and so for California, we don't expect any different than for the US. But in terms of the impact on household budgets, with this reduction in the housing stock and the constraints that we have, in construction, likely the consumer price index for California will be increasing at a slightly higher rate than the US. Okay, next question.
Question about the data you showed on employment. You listed about 120,000 jobs created in healthcare and social services last year. How does that compare to the national average for a state? And is that sustainable? Can you back to that?
So healthcare has been growing, throughout the U.S. as we boomers age, and also there's been an increase in the need for home healthcare. I don't know what the exact comparison is to the U.S., but to your other point, is the increase in healthcare employment sustainable? The answer is no. We expect both in California, and I was just emphasizing California, but nationwide immigration policy is going to reduce that. A reduction in funding for Medicaid is going to reduce that demand, and so that is not going to be one of the growth sectors going forward. Okay, we have time for one more question. Yes.
Seems that there's a lot of negative effects from we're predicting from these policies and changes, especially the tariffs. Are there hypothetical positive outcomes from them? And if not, are these effects potentially reversible? Back based on.
Okay, so that's a great question. Let me repeat it. We've been talking a lot about the negative effects of many of the policies and directives that thus far have come out of Washington. Are there positive effects? And so let's think about this in terms of the goal of some of the tariff policies, like the increase in tariffs on China. The idea is to get to an economy that is less dependent on Chinese production for a whole set of reasons. Some are national security, some are just a desire to decouple. When U.S. companies and the Chinese government decided to create these very efficient supply chains, right? We had disruption, we had unemployment, particularly in the Midwest, right? Because you're getting a changed economy. This is similarly, we're getting a changed economy. And so ultimately you'll get to kind of this new equilibrium, which will be a different economy. But people who are working in these long supply chains are going to be losing their jobs. Companies that are there are going to be suffering from this, and other companies eventually are going to start up. So these are transition costs. They can be very large. they can be small. Certainly the opening of China was called the China shock. They were quite large for parts of the country. Our forecast goes through 2027, so we're only looking at the near term. But the objective is to change the US economy. And so if that's something that you think is a good idea, then that's a positive aspect to it. But there are near-term disruption costs. In fact, the president last night, was it last night? In the State of the Union address, said, minimized, but said, yeah, there are going to be some transition costs. What we're trying to illustrate is those may be very high. Okay, very quickly, but we have to turn to our panel.
Situation. Those two affected areas could actually fulfill the number of years it would.
So the question is there a forecast of the number of years it would take to kind of rebuild manufacturing? In Palisades and Altadena? We don't know. The Woolsey fire area, 2018, not all the homes are rebuilt. In Coffee Park, which is Santa Rosa, in the Tubbs fire, it was 5 years. Okay, and with that happy note, let's turn to something happier. Let me introduce my colleague, Terry Kramer, who is the faculty director of the Easton Technology Management Institute, as well as a professor here at UCLA Anderson. And Terry, I'll turn it over to you to invite your panelists up and introduce them.
Please, once you guys.
Thank you.
Excellent. So hopefully, as Jerry mentioned, there's a bit on technology and outlook of technology. This panel is going to be focused specifically on artificial intelligence and looking at it from a couple of angles. Number one, what does it do for product development? New products of established companies, of new companies, et cetera. And we're going to look at how it affects new venture creation, because there's a lot of opportunity there. Now, just to do a bit of a level set on what is happening with AI, there's quite a bit. And I always think of AI in a couple of buckets. One is machine learning that allows for predictions of a lot of different types. Recommendation engines, companies that want to predict customer behavior, demand forecasting, et cetera. Second type of AI is artificial intelligence related to generative AI. And really in the last years when we're seeing a lot of changes. Generative AI offers the ability to create content and it creates the ability to interact. And I think those two elements is why we're seeing so much activity. If you were to look at use cases related to those two types of artificial intelligence, we would see a variety of things. We'd see in the enterprise markets all types of CRM, customer relationship management interactions. And matter of fact, we'd see billions of those, 80 billion interactions from companies like Salesforce that are providing services to a lot of enterprises to interact with their customers. We'd see a variety of search tools, so ChatGPT, Google Gemini, that have created new opportunities for discovery. We'd see chatbots of all different types. Conmigo. Conmigo is an AI-based tutor that the Khan Academy has launched. So it is literally going to create improved forms of tutoring at lower costs and broader access. We'd see a variety of other applications. Salesforce has got a variety of agents, and these agents are AI agents that are able to provide a variety of services for end customers related to sales and other customer inquiries. So as I mentioned, there's a lot going on today. We're going to talk more specifically about what are the applications. We're going to talk about what it does in terms of creating, new ventures of all types. So we've got two great speakers that are with us today. On my far left, we have Mark Thomas. He's the Senior Director of Product at Reddit. And he leads there a developer platform team. And he's got senior product management experience at a variety of luminary tech companies, including Google, Snap, and again now at Reddit. He's got a bachelor's degree in computer science with honors from UC Berkeley. He's also got a master's degree in computer science here from UCLA and an MBA also here from the Anderson School. He lives here in Los Angeles with his wife and 2 sons. So first of all, Mark, a big welcome. Second of all, we have Matt Kozlov. Matt is a managing director of 3 of the top venture accelerators in the country. Techstars LA, that's in partnership with JP Morgan, Techstars Healthcare in partnership with Cedars-Sinai, United Healthcare, UC Irvine Health. And Techstars Space in partnership with the United States Space Force and NASA's Jet Propulsion Laboratory. His companies have raised over $800 million. They have valuation of about $4 billion total. So quite a few successes through a variety of companies. Prior to being involved with Young Ventures, he had a variety of executive roles. Matt was the head of corporate development at Telesign, which is a leading anti-fraud company and one of LA's fastest growing tech companies. He was previously the CEO of Moonshark, which is a venture that was backed by creative artists and Qualcomm that brought mobile content and entertainment to the marketplace. He also has worked for Sony Music Entertainment, for Yahoo, for Bain & Company and consulting. He graduated from Harvard with a degree in economics. So again, a welcome to both of you. I always like to start out with the most kind of overarching questions. We get your perspectives. As you look across all the different applications of AI, what are the areas you're most excited about? Mark, you want to start?
Yeah, I'll give you 2 for the price of 1. The first is I'm a software person. And one of the things that I'm hearing from all of my colleagues in software engineering is how AI is transforming how they write code. I've had a friend who's a machine learning engineer. His job is to build these systems. And he said the latest release of Anthropic's model, which is Claude 3.7, if you've heard of it, has increased his personal productivity by, he estimates, 24x. Now, this is a very mathy person. This is somebody that has tracked this since the early days of LLMs. And he says, this has been sort of exponentially increasing for him. I can tell you myself, I am not a very good software engineer, though I was a software engineer, interestingly enough, at the Aerospace Corporation. I noticed you're going to have the CEO here later today. And I can write code now, again. It's really transformative. When you think about that, when you get the people that are building software, we're going to get more higher quality software coming out in the next 6 to 12 months. I think it's really transformative. If you haven't seen bolt.new, or if you haven't gone to replit.com, go check it out. They have these prompts where you can ask for an app, and most of the time it'll give you that app with a one-shot prompt, and they'll give it to you running. It's really, really I think empowering and also transformative.
The areas that get me most excited are, it's funny you mentioned that, and I do think of AI as like an exoskeleton for your brain. Like it makes you and everyone you know better at what they do. That can include physicians, aerospace engineers, and I spend most of my time in healthcare and aerospace and defense, so you'll hear me talking a lot about that. But where I get the most excited about AI is on the generative design side of things, where AI can help conceive of concepts and designs and solutions to problems that the human brain couldn't. It's just, so much more data, so many parallel paths that a single human could never come up with that. Think, if you're trying to design the lightest, strongest structure to put into orbit for some kind of apparatus, right? When you use a generative AI tool, they'll come up with like a truly alien looking thing that the human brain wouldn't know how to conceive of. And that can apply to protein folding and coming up with new molecules that the human brain could never imagine. And so I do think that when you look at that type of computer assisted design or entirely computer generated design, it's going to move us into this like singularity moment where just the pace of innovation is happening so quickly, and it will compound as we have all of these new solutions and new tools working together to create even more new solutions and new tools.
Good. So if you take it the next level down with the different applications you've talked about, the sectors that are likely to see the benefit most quickly, is it tech? Is it healthcare? Is it retail, media and entertainment? Give us a bit more sense on a sector basis.
Yeah, and I'll also answer the second part of my first question on this one. Because software powers basically everything, it's going to be everything. I think you'll probably see this again. It's going to take a little while for this to this is why the software element of this is so transformative. If every engineer out there can be expected to do 20 times more than they are today, and if people that couldn't code now can code and create apps or software, I think you're going to start seeing this wave of things just being transformed. And the combination of what you're saying with the wild ideas of people that have been locked out of creating software because they didn't go to CS school or they didn't take the time to learn how to write code, creating things, you're going to see, I think, transformative things everywhere. Where that will probably manifest itself first, I would look to startups that, our venture capitalists and investors are looking at. So I would go to the portfolio companies and just see what they're seeing. So I've seen things in fashion and healthcare. I mean, it's basically across the board. Mineral mining, stuff like that. I mean, everything I think stands to be disrupted here. And by the way, the second thing, software or AI application is Suno.com. If you haven't used it, it creates songs based off prompts, and I use it to create songs about my kids, which they absolutely love. They're dumb songs, but they're like, I would say, you wouldn't hear them on the radio, but they'd probably be like track 12 on an album sort of thing. They're pretty good. So when it comes to media and entertainment, I think that's also an area where you're going to see, again, this theme of people that haven't been able to create now creating stuff that is actually pretty good quality.
I mean, we could go down the category by category by category. I think everything is being disrupted, as he mentions, and it's hard to say which is going to be the most. But the one thing, and we talked a little bit about this on our prep call, was I don't think the average consumer has felt it yet. Everyone here probably has an iPhone with OpenAI in their pocket, and my guess is that very few of you use it on a regular basis. I certainly don't. Like, it is not a daily occurrence for me, but I do think that's going to start to change, whether it's agent AI that we use ourselves to solve problems. I don't think those have yet hit the average consumer, and I have some really interesting healthcare examples of things that I'm putting some money at bat in. But I do think that on the enterprise side of things, we've been seeing it hit and hit and hit at a much faster pace. But I am curious, like, when is that wave going to hit? Just as the internet hit and mobile hit, when is it going to hit the average consumer in a way where we can't live without it? I don't think it's hit yet.
Yeah, so on that question, this is kind of the next kind of leading question, is the penetration rate of AI. I always find it kind of interesting to say, what percent of people are aware of AI? What percent of people are actually using it, et cetera? Just if you give it macro, I know there's been no formal forecast on it, but consumer and enterprise, where are we on penetration of AI? Mark?
I think 100% of people have heard of it. 99.8% of people have used it once or a couple of times. Everyone here has gone to ChatGPT and tried something, right? But in terms of things that, as we think about it, and at least the tech industry, is it passing the toothbrush test? Is it something that you're using twice a day? What's interesting is you actually probably are using it twice a day, but in a place that you're very familiar with and a place you may not notice it, and that's search. So you might see when you go do a Google search, they've got these summarized answers and things. I think that's probably the first place everyone is going to feel it and start using it on an toothbrush level test. How long until everyone uses it? Oh man, that's really tough. It could be next week, or it could be, I would say, I would put it somewhere in the next 18 months is where I would guess. And I think this is where I think there's a tremendous amount of opportunity. We've got this incredibly powerful tool, but we haven't quite figured out how to use it yet. It's just kind of like, the first version of the iPhone, everyone's like, wow, that looks really cool. But, we have to remember back at that time, it didn't have an app store. It didn't have apps. It didn't have copy paste. It basically had, a mobile browser, and the web was hard to browse on it. People were kind of like, oh, that seems really cool. But it took another 18 months, 3 years, something like that before it really became what we have today. I'm an optimist. I'd say 18 months.
I think, just in terms of like the penetration rate, I'd say we're at like 1% of consumers using it. And I'd say like 10% of enterprise or like professionals. It depends on the industry. But I do think, that will increase rapidly. Like AI still doesn't do anything for me. Like as a human being, the case I was going to give is I had a back problem a couple months ago. I went and saw my physician and he prescribed an MRI and physical therapy. And I made a reservation at the MRI clinic that he told me to do it. And then it got canceled because my insurance wouldn't cover it there. And then I had to book at a different MRI clinic that my insurance would cover. And I had to get an appointment at that place. But in order to do that, I needed to get a prior auth from my physician to change. Like, this is painful, right? Like AI should be able to do all of that. Like just figure it out for me. Here's my calendar. Tell me when I can get the earliest appointment at a clinic within 5 miles from me that's covered by my insurance. Why should I have to do that? When AI can do that, then we're in a different game.
Good. So
Maybe diagnose you too.
yes, which is
Yeah,
the big value add. So we had the CEO of Amazon One Medical Group here a year
There you
ago.
go.
I found it fascinating. He obviously cannot speak specifically about where they're going and a variety of things, but I basically asked him on a scale of 1 to 10 on transparency. When you look at core products that Amazon sells today, paper towels, et cetera, transparency of price, transparency of availability, transparency of quality ratings, kind of the classic things. I said, tell me, where do you think we are via Amazon on transparency of information on those dimensions? He said it's kind of an 8 out of a 10. I asked him the same question for healthcare. The number was like a 2.
It's a tip. Yeah.
Okay, so on that topic, maybe Matt, you'll start out, but if you say, is there an Amazon model out there that's a platform-based model that matches healthcare providers with patients that can provide that type of transparency, does that create a major change in healthcare as we know it?
That's not going to happen. Healthcare is so broken in this country. The way that healthcare is delivered and paid for, we're so broken. I don't think there's going to be one, business that comes and fixes it all. It's an entrenched system that, generates a lot of money for payers, and, it's just an incredibly complex system. Cedars-Sinai, does anyone want to guess how much Cedars-Sinai spent 15 years ago to put in their EMR? Someone throw out a number. Someone want to throw out another number? What'd you say? It's about a third of that. It was like $300 million to put in place a software system that they can't live without, right? Like this is like an airplane. You can't now fix it. There's no ripping and replacing this with a new system. It controls every single element of your healthcare delivery. And there are 2 software companies in the world that provide EMRs for health systems, Epic and Cerner, which is owned by Oracle. They're going to make it better for themselves, but there's no new company that's going to come in my opinion, and completely transform and change how healthcare is delivered.
Mark, your thoughts?
Yeah, I hear that as a real good challenge. I agree with you. My healthcare stories, I've got 150 like little small things that I would like to have just somebody tell me, hey, you're getting older, just go deal with it. But it's concerning enough for me to go check, and I can't do that unless I go to an urgent care clinic or whatever. And I do wonder if there was a way, if there was an outside system, probably not a single company, but if there's one place you could go where you could get reasonably good enough diagnosis, primary health advice, maybe not care or whatever, what would be stopping that? And if there were an AI that was as good as all the doctors combined together that could tell you that, and it could do it over chat based off of information that it gets from your phone, then would people use that? Would people be willing to pay $1 a month for that over, whatever? Would they be willing to pay $100 a month for that? I don't know. So while I generally agree with you, I think that's going to be a really hard one to disrupt. I would love to see it disrupted. And I hope that there's some entrepreneurs out there that are, taking this as a really good challenge with AI in their toolkit.
On this, if you don't mind me just chiming in.
We were just getting out of the economic forecast, which seemed very downbeat.
No,
and I was
I'm
counting on
gonna
you
make
to
this.
do
I'm
it.
gonna make this more encouraging. Doctors and nurses are burnt out beyond craziness levels right now. Right? They spend over half their time in the electronic health record, typing up notes and just doing repetitive task-based labor. I think that can be wildly changed. I am seeing software AI tools that make a physician's appointment with you more efficient, that takes less time away from the human interactions than the current technology does, that might even make doctors enjoy their jobs again, which I really hope they will, because 40 years ago, doctors were better than they are now. They hate their jobs. They're driving out in herds, and I do think technology can make. And technology is supposed to make their jobs easier, but it's made their jobs harder in so many ways. And I think this can finally be that like exoskeleton for them that helps them catch diagnostics better, leverage their peers better, leverage, the thousands of data points that might not be available to them because they don't have access to it in real time or using AI. So like this is where I see a lot of optimism.
And if I may, that reminds me of an anecdote. So a little known fact that Sam Altman, who's the CEO of OpenAI, was briefly the CEO of Reddit, and was on our board until I guess he made a ton of money and decided not to be anymore. But he was in a conversation once, and somebody asked him, hey, when am I going to get the AI agent that's just going to answer all my emails? And he responded, I'm not that interested in that problem. I'd rather it just control your computer, and then you just say, take care of my daily stuff. And so I think this idea that what these companies are aiming for is something that is far more intelligent and capable than even we think they could be today, to the point where you could have an AI reorganize an entire hospital system for you. You could actually have it be something that says like, hey, you know what? I don't know how to solve this problem, actually. Can you just design, give it the parameters? I need to design something that costs me as the business owner less than $1,000 a month to run with rent, can serve up to 100,000 users that are paying this much, and provides diagnosis that a primary care physician could. Can't do that. ChatGPT 4.0 can probably give you a plan for that. I don't know how realistic it would be. ChatGPT 5 might be able to implement it for you. And I think that is something that is, it sounds like science fiction today, but so does everything that we have right now, 2 years ago. So, I'm a bit of an AI optimist in this front, but I also like to believe that and then be proven wrong in the next few years.
Good. So let me ask you the next one, because both of you have touched on this. The AI applications, I tend to think of them in two buckets. One is cost savings and time savings for an organization, a little bit of the healthcare example you brought up. The second one is revenue opportunities, new products, new capabilities, diagnostic tools, et cetera, et cetera. Where do you think we are right now, if you'd say rough mix between the two? And where do you think that mix is going? Matt?
I think we're still mostly in the I think atoms versus atoms and bits. And now I'm going to put the aerospace side of things on for a moment. Where I think we're starting to see the most interesting applications for me is when the software isn't just designing solutions, it's actually building them, right? You're creating robotic outputs of the software designs, and now we're building and controlling systems that are actually making things and making them better than humans can. I think we are in the early stages of that, and I see enormous potential. There are a lot of companies doing some really cool things that do seem like science fiction, building houses, building large scale aircraft and naval ships that are stronger, lighter, faster than we were able to produce 40 years ago. At the same time, I'm devastated to see that the human side of things is very scary. We're seeing aircraft falling out of skies. We're seeing them flip over on airports, and that hopefully will get a lot better with better technology. I don't want to be a techno optimist on everything. There also has to be policy regulation changes and improvements in staffing and training. So it's not all up to the machines. We have to do better as humans too.
Yeah, I think right now, what's shocking to me is how hard. I think we're going to see it first on the cost optimization front, though I'm surprised at how long it's taken for even tech companies to adopt this. So as I mentioned, I think the software side is what I know best, but every coder on my broader team, I basically demand that they use AI. And a lot of them, I have to push them to do it, which is kind of crazy to me. But now I'm having conversations that, for example, we're trying to build some games. And we've got some people that are like, I've never built a game before. I'm a back-end engineer. And I was like, you have AI. Guess what? You are now a full stack engineer, an expert game designer. And, I need to design a complex economy. Take a look at like Monopoly Go, for example. That seems like it's a really profitable game, made $3 billion last year, more than Reddit alone. And how am I going to replicate that? Ask AI to do it. And then you don't have to worry about that. Now, all of a sudden, I can start pushing my engineering team to do 20 times, 30 times, 40 times more than I would do. Should I hire a game designer? Should I hire all this stuff? I think there is a human component there where I think I could get some value out of that. But right now, I'm going to work with what I got. So you're going to see that cost reduction for the companies that lean into it sooner rather than later. It'll probably manifest itself in we'll keep our headcount growth relatively low this year, so our costs don't really increase, but they're not going to plummet by 10x. Just because we didn't have to hire 10 more people to do this job, I could actually push the people I have, and they're excited to do it. When will we see the revenue? I think we'll see it through your companies, I hope, soon.
Excellent, Matt.
I think I already addressed.
Okay, cool. So let me ask you now kind of the next question that flows from a lot of this is what you're seeing in your own worlds. So Mark, maybe let's go back to you again on Reddit. If you were to say top 2 or 3 cool things that are happening at Reddit with AI, what would it be? And then Matt, I'm going to ask you about new ventures.
Yeah.
Top 2 or 3 ventures that you're seeing that you're really intrigued with.
Yeah, I think Reddit just recently announced a product called Reddit Answers, which is basically search. And part of the reason I joined Reddit is because I was looking at Google Trends data before I joined them, and I just searched for Reddit on Google Trends, and you just see this massive uptick in searches for the word Reddit, and that's because people were figuring out that when you searched your search term and then threw Reddit on the end, you got better results. The reason is because the content on Reddit was so good. That it was so authentic. It was curated by humans for humans, which I think is a really important thing that won't go away as long as we have humans. That's something that really people were gravitating towards. So Reddit Answers was basically, well, hey, now we can do search too. In the past, it would have taken millions or tens of millions of person hours to replicate what Google did, or some sort of deal with Google. That would cause us to sort of probably be disadvantaged to them in some interesting way and so on. Now we can just compete. And so search has become commoditized. It's not just us doing it. Obviously, there's lots of other things like Perplexity that are coming out, and everyone can have a search engine now. So I think that's something that is on Reddit today. The other thing that I see in my world is, again, I built like an app store for Reddit. And so we have a bunch of app developers out in the community building things, and they tend to be hobbyists. And we're seeing them produce some really incredible apps. Now, this is still small scale, it's still new, but what I think you'll see over the coming years, what I hope you'll see is brand new ways of using Reddit that are designed by people who use it. And oftentimes that'll be people that aren't traditional coders. So I think that's really powerful.
All right. So satellites, we've got thousands and thousands of them up in orbit. And that's only increasing. And as the complexity of the spacecraft in orbit becomes increasingly dire, the risk of collision is a problem. And so now we need to have propulsion. The satellites need to be able to move and avoid each other and engage in collision avoidance, and maybe for military tactics, actually go to specific places and accomplish a mission. All right, so there was a company that in 2019 I invested in that made an electric propulsion system using gallium metal as its fuel. And these guys, took them years and years and years to design this like really complex propulsion system. They flew it into orbit. Fast forward to 2025, there was a team in Australia that developed generative AI software to design and look at all of the trade space, look at all of the components, look at all of the different fuels, look at all of the different ways that they could design a capillary system to build the best propulsion system. It took them 2 weeks to design a propulsion system. Wow. 2 weeks. what took years now took this company 2 weeks. So they pivoted from making propulsion systems to just selling their software, because it turns out you can use that to design other complex electronic systems. So that, I think, is, emblematic of the kind of sea change we're seeing on the one hand. I mentioned physicians getting more efficient. We have a company called Regard Health that's doing that, that is genuinely making money, because they're not only saving physicians time so that they can see more patients, but they're also capturing billing codes that the physician might not have noticed because they didn't look at the hundreds of pages of back data on the patient and see these codependencies that they can actually bill for. So there's like revenue generating and cost saving opportunities in healthcare and AI. But where I think the most interesting opportunities in AI are actually outside of the LLM layer. I think that the AI companies that are going to win, now that you're almost commodifying the back end, are the companies that have truly proprietary, unique data sets that nobody else has or can build themselves. That's what, as an investor, I'm looking for, because anyone can build something on Claude or ChatGPT or Perplexity, right? Like, even Perplexity is itself a skin, and I don't want to undersell what Perplexity is, but that business is itself an iteration of an existing underlying infrastructure. So how do you win in AI? You have data that nobody else has. So maybe that's the world's most largest proprietary data set on electrocardiograms. Maybe it's the largest proprietary data set on propulsion systems, or how people design specific things. And I think that, if any of you are entrepreneurs in the room, you should be thinking about what proprietary data lake you can own that nobody else can, and then how do you use existing tools to make that as valuable as possible.
Yeah. Excellent. So fascinating discussion, because I want to get into this in more detail about who are going to be the winners. Because you both have identified at a macro level, the AI opportunity is quite large. The number of sectors, the number of applications, the value per user, et cetera, et cetera, et cetera. The next question is, well, who are the winners going to be in this? And I think, Matt, you've already kind of identified people that have unique data sets. Mark, let me go to you, because there's a variety of dimensions to look on this. People would say for a while it's large tech companies, actually, because in aggregate, they have a lot of data. Do you see it large versus small? Do you see adoption of AI being actually what's going to create the differentiation versus not? Just say more about where you see the winners here.
Yeah, I think I could not agree with you more, Matt, that the folks that have and are able to collect a proprietary and difficult to scrape, very importantly, data set will be win. So when you think about the suppliers, if you think about the actual core models as being sort of the middle of this value chain, you've got suppliers on one side, this side over here, and then you've got the applications on the other side. I think there's opportunity in both the supply side and the application side. On the supply side, data is the biggest area for opportunity. I think the other winners are cloud hosting providers, people that have infrastructure, obviously also the hardware providers, at least today, so NVIDIA and all those. That's I think cloud hosting, manufacturing, chips and so on, that's big tech. You're going to win there. Data sets, I think these proprietary data sets will be really, really interesting. Keep in mind that these models have already scraped every single piece of publicly available data. And they were incorporated in GPT-3, if not GPT-2. Okay, so they already had it all. The problem they have right now is they don't have enough. And so they're at this problem where they now have to start synthesizing data in order to get enough data to progress the systems. That's, I think, one of the reasons you're not seeing GPT-5 and Anthropic Claude 4 come out yet, is because they just haven't gotten that right. I tend to think a lot more, like if I think about diversity of opportunity, there's going to be more on the application side, because again, as we mentioned, we have this powerful hammer. We don't quite know how to use it yet. So the folks that are able to figure that out, I think will be doing very, very well. I think there is a question about, well, will they just get scooped up by the large tech companies? I think there's a really good chance of that happening. Though I think there's also opportunity for them to be disrupted. I think Google's very scared right now, because there could be a better search engine that doesn't rely on, for example, advertising in the same way, or sharing of personal information the same way that Google does. So we'll see. But yeah, data and applications.
I think the winners, the ones, just extending from what I've been saying before, data is more than just databases of data, right? It is also people and how they work and how they act and how you're going to log those interactions into a way that you can learn from it. You know, it is doctors making diagnoses. It is aerospace engineers building things in, you know, in complex environments. It's people in Africa buying, you know, cans of Sprite that currently are being done with money, right? Like these are all offline interactions that are not even scrapable because they're not even capturable. And I do think that the winners are going to be the ones that figure out how to do that in proprietary ways, whether it's, you know, building technology at those edges that capture those interactions that they can then own, or whether it's working closely with a hospital and 100 physicians to capture that data in a way that nobody else can. But then it's also knowing who the customer is and how they buy. Because at the end of the day, and like this is, just because you build a great solution doesn't mean you have any clue how to sell it. And I think that's, you know, especially in these more complex industries like advanced manufacturing, healthcare, aerospace and defense, where there's a lot of regulatory hurdles, when people are maybe a little bit nervous about putting in a black box solution that they don't understand. You know, you can maybe cut those sales cycles down, but you still really need to know the buyer. So there's no substitute. You know, you can't AI your way into, you know, winning in a difficult market if you don't know the industry.
Okay. Last question on this topic, and this is one of those ones you want to say, I'm going to forget my employment and my interests, et cetera, and just macro level. If you look at value creation potential, if you're an investor of some sort, and you look at value creation potential in this broad arena, and you're trying to decide, is more value creation going to happen with large companies, large tech companies versus small? And let me give you another data point. There's a lot of work that's gone on what's called competing in an age of AI, which says that companies that are digital first and data first are going to have an advantage when they compete with traditional businesses. The second part, though, is it says those companies that have that data and that scale benefit there tend to move cross-industry. So it's Google that goes from search into Waymo as autonomous vehicles. I'll bring up Amazon one last time. I'll be risky here, but they're going to go from e-commerce to healthcare would be an example. But basically those data sets allow companies to move cross-boundary because there's network effects with data. Based on all of that, where do you think, if we were to fast forward 5-10 years from now and say, who's kind of one disproportionate share of this AI and data opportunity? Is it bigger tech or is it young ventures? Mark?
Yeah, I realize I didn't quite answer your prior question here. I think I would place a bet that big tech's going to win because of these network effects, because they have such deep pockets, because they have all this other stuff. I do think in the medium term, though, and certainly in the short term, we're going to see most of the innovation come from small companies and startups. I'm thinking of you know, the fires, for example. If the companies that can win here, I think there's a ton of opportunity for people to use AI and other things to do a lot more to you know, a very small firm to operate like a very large firm in whatever area they're looking at. If it's architecture, or if it's supply chain management, if it's trying to acquire and negotiate prices and so on. I think there's a lot of things that could be done by an enterprising young company that large companies just can't shift to do. I think at the longer term, though, once you see that level of success and those entrepreneurs are offered $1 billion out by one of these companies that, you know, figured it out, the chances that they'll take it historically are pretty high. So I think short to medium term, I think there's a lot of opportunity for small businesses. Longer term, I would put a bet that the big tech are probably going to win.
Interesting. Good. Thanks.
So it's this classic innovator's
It
dilemma
is.
question, right? And, you know, history will tell us that the startups generally win. You know, I think that who the legacy incumbent player is in any different generation changes in different industries and different eras. You look at aerospace today, you know, no offense to Lockheed Martin, Boeing, Raytheon, Northrop Grumman, but they're not as exciting companies to retail investors or to the DoD even as SpaceX, Anduril, and Palantir are right now. Those are names that were probably not on the tips of people's tongues 10, 15, 20 years. SpaceX is a 20, you know, something year old company, but the others are pretty new. Amazon has tried and failed more times in healthcare than you can imagine. Same with Google. Typically, and again, at least with complex industries, it's not as simple as just, oh, I'm going to go there now, put a lot of money in it and succeed. Doesn't happen. They're really hard. I think innovation is going to be faster than ever with AI, and startups are going to be able to build products and get to revenue faster and get customers faster than incumbents are maybe normally working at. But at the same time, those incumbents have access to the same AI tools as the startups do. I get nervous about this sort of like just from my own portfolio perspective, like companies that actually do have access to data and know their industry really well, like I worry about Epic and Cerner more than I do about Amazon or Google, because they actually do sit on the same level of data, but they sit across 5,000 hospitals worth, whereas any startup might only have 5.
Yeah, makes sense. Let me ask one last question, then we'll go to audience questions. And again, it flows from what we've just been talking about. We've been trying to figure out who are going to be the winners in this future environment. What are the areas of AI opportunity? Taken now down to the individual level. Are we going to see a big disparity of outcomes, a digital divide of people that are using AI, people that are not using AI, that creates a broader societal issue, a broader macroeconomic issue? Are we going to see this across the world? Because the classic arguments in this area are, jobs, AI is not going to take jobs from people, but people who use AI will take jobs from those that don't. And people say that at an individual level, a company level, and a national level. Your views on that, Mark? Start with you.
Yeah, that's a big one. I think generally, yeah, I think there will be a difference. I think people that deeply understand how to use AI and lean into it will be able to access more economic opportunity. The good news is that accessing and using AI is as simple as accessing and using the internet. And so I think you're going to get a lot of hungry people from across the globe that have been maybe shut out of prior innovation cycles in some ways. I think, obviously I'll be sitting in a pretty good spot working in tech and having access to AI and being very comfortable and all that stuff. And so I think, I don't know how that'll pan out. There's, of course, I think about the far future here. I think there's sort of a possibility where AI continues to be basically just a useful tool. We kind of plateau there. There's also that science fiction world where it becomes a super intelligence and then it does things that, we can't even imagine in the 5 or 10 year time frame. I do think that's a non-zero probability that does happen. But assuming it continues to be a useful tool, is what we know of today, then yeah, I think there's going to be a difference. But again, I'm having trouble convincing people at large tech companies to use it. So I think the resistance to it or the slowness to adoption is I think universal in different proportions, but definitely universal. So there's a real opportunity now.
I do ultimately think that it's a democratizing tool in the same way we used to talk about low code, no code solutions. I actually don't think I've heard those phrases used in like a year since AI started rolling out, because AI is the best low code, no code tool that you can imagine and does, bring the ability to code to anyone who doesn't have the ability to code, which should be a leveler. When JD Vance went over to Europe and scolded them about trying to regulate AI, I thought that was a turning point conversation, which is like, can you put AI back into a box? Like, it is exploding in its maturity every couple months. It's getting wildly more powerful to the point where like, I don't know where it's going. I don't know what the future looks like in 3, 6, 12, 18 months. We could cure cancer within like a year or two at this rate. We could, the robots could be building robots at this point. Like, we genuinely are advancing at such a pace that it is hard to know what's going on. And I don't think regulation is going to put things back in the box, but we do have to be careful because, we've seen the movies. We know what happens when, if you don't know the paperclip the paperclip
Great
paradox,
goo.
or
Yeah.
like, yeah.
Everything becomes a paperclip.
Yeah, if you tell AI to build, the most efficient paperclip building machine, and you give them all the tools, they're going to basically consume every resource on the planet, because all they're doing is trying to make paperclips, and we are now in their way. Like, that is the problem. That is the thing we need to avoid. So there do need to be some guardrails, and ethical AI is what OpenAI has always been standing for. I hope they don't lose the ethical part of what they're trying to do.
Yeah, I will just say, if there's one thing to look at, I think the AIs that are coming out do actually have values encoded into them. And I think it's important to think very hard about what those values are and how you test that, because there's also there's what it says and what it does. The good news is the way we interact with AIs, we've had a lot of experience with it. It's like interacting with humans. People expect to be able to interact with AIs the way that they interact with machines. Like, I give a input and I get the same output every time. But that's not how humans work, and that's not how AIs are going to work. But we've gotten pretty good at sort of managing that. So hopefully we don't get to the paperclip scenario, because we tell them, hey, just don't do stuff like that, and it figures it out. But we'll see.
Okay, so let's go to audience questions. Let's take just a couple of questions, and then we'll do a wrap up. Really loud voice for us. So on a global scale, who is ahead, and does it matter?
At a country level?
Yeah.
It's either China, if you believe DeepSeek is as powerful as it is, or us, and I'm not sure, but those are the only two that matter, if you ask me.
Yeah, I would agree. I would say we're still ahead for now, but that could change very quickly.
Yeah. Excellent. Yes.
Thank you both for coming. So I have a question for Matt. I work in medical device regulatory affairs. How do you see, you mentioned like the software that designs electronic systems for pulses. How do you see like AI affecting like medical innovation in terms of rapid prototyping and being designs? Will it completely replace like usability or like product design experts?
Yeah. So the question was, in designing medical devices, which is typically a long, lengthy process that requires human factor design and engaging patients in multiple stages of studies before you get to the right thing. How will AI make that process better? And I will say the exact same thing. People who are using AI are going to probably be faster and more efficient and come to better designs, but it's still going to be a human-driven process, I believe. You need to still have patients in the mix. You still need to have experts in the mix, and you still need to go through the regulatory safety frameworks. You need to prove efficacy and safety. Like, I hope that doesn't go away under this administration. We really need, but we also need things to come to market faster.
Excellent. We'll take one more in the back there. Yeah.
Yeah. So Terry, you mentioned Conmigo. So one industry you guys haven't mentioned is this one here, education.
Yeah.
So what's going to happen? Are we going to have MBA programs?
Yeah. Are you asking me or them or all of us?
No, I know you.
Yeah, he wants to hear from you. And watch what you say, because you might never get invited back here again.
Well, so I also, Terry's given me the opportunity to teach here as well on occasion. And I think, is the way I teach a class today maximally efficient? Absolutely not. If I think about the way I would really want to teach, I would want to teach each individual student at their own pace and challenge them as much as possible with the time I have for them. I kind of imagine how like standardized tests sort of work. At least I've been told, you answer a question correctly, you get a harder question. You answer it incorrectly, you get a slightly easier question until it finds out where you are, and then it pushes you. That's what I would ideally like to do. And I do think that there's an element where AI can help me do that as an instructor. And by the way, it should work for my 9-year-old starting now, who's bored in his third grade class, and my 4-year-old who hasn't really started. What would happen if somebody was educated that way their entire life? Would they actually need to go to MBA? Well, I'll tell you that the last thing I'll say is that the value of MBA was always broken down into thirds. It's a third academic, a third social, and a third experiential, I think, something like that. So 2/3 of your stuff is not the content being taught to you, but who you're with. And I do think that matters and will matter forever. And of course, with great instructors and great academic directors leading it, the quality of the academics might be more like 50 or 60% of the value. I'm just saying.
Continued employment has been offered to you.
I have nothing better to add. That was great.
Before you wrap up.
Yes.
I mean, this is a great panel, really informative and interesting. But if we rewind and replace the words AI with .com or internet, we're back in the late 90s. A lot of promise didn't really come to fruition for a decade, right? How is this different? Or is it?
But it did, right? It just didn't go as quickly as people hyped it up to be.
That's my point. So we had the .com bust, and is this different, and if so, why?
I would say scaling laws. Sorry, it's a industry term. I mentioned coding as being something that's gotten a lot better. You know what relies on software is the models themselves. And so this is something where I think the people who are working at these companies can make the models exponentially better. They're all 20, 30, maybe using the latest models 100 times more impactful and productive themselves. I would expect that has a probability of accelerating that advancement exponentially. Now, will it take 10 years or 5 years? I don't know if anyone's read The Singularity is Near. You referenced it. It was a great book. And they talk all about this. It's just the pace of innovation is increasing exponentially.
What is the pace of adoption?
Well, I think that depends on good entrepreneurs at this point finding those right toothbrush test use cases. I think we have found it with coding, and then that is something that again will unleash. If everyone can create applications and you can prototype it in an hour and go get user feedback in the day, the people who are really leaning into that, I think you'll see that happen fairly quickly. So 18 months, I'm still giving you, a little bit of time, but I think it will happen faster if it's possible.
I would also argue that I'm no expert here on this particular issue, but I was pretty young when the .com bust happened, but it seemed to me more of a market failure where the market was overly exuberant on business models that weren't proven. They were a little more than a PowerPoint and, a couple early metrics, but there wasn't a lot of here just doesn't feel like as much business model risk or technology risk. It really does seem more about when it will happen and how it will happen, not if it will happen, which I would argue, all of the promise of the .com potential has ultimately come true, not necessarily to the companies that were saying it would, though.
I do think I look forward to the spectacular failures and the things that people thought had a lot of promise, but then just completely implode. Like, what's the QCat of the AI boom? QCat was a cat-shaped QR scanner that could plug into your mouse thing and got like $10 million worth of an investment. It was the hot thing for a couple of days. I mean, can't wait to see that. It'll be hilarious looking back.
Good. So listen, I always, when I finish these, like to do my so what's, which is what I've taken out of the conversation here. And there's quite a few items here. The first takeaway that I got here is the number of sectors, the number of applications, the value per application is all quite high here. And by the way, that last part is the answer to Jerry's question is also the value, the capability of the application is, I think, much better than it is just with the internet, which is kind of conducting a transaction, but it isn't the thinking and the reasoning in the same degree. So that's kind of the first point I took away. The second point I took away was on this issue about cost and efficiency, a lot of the early applications in that area, but more and more shifting to product and revenue and deeper capabilities. We haven't seen that movie play out yet, and that will create a huge lift. Number three, the penetration rate is still very low. This opportunity, if we get to from 1 or 2% adoption to 30, 40, 50%, we get a very, very big market here. Next issue is on competition and who's going to win. It's not 100% clear who's going to win. The LLMs, early sign, are getting commoditized, but the ownership of data matters a huge amount. That is still the oil here, and that ability to own data. Question mark whether it's big tech companies or young ventures. I think some of the trending was more towards big tech as I kind of tried to synthesize everything both of them were saying. Couple last items here. Implications for individuals is quite pronounced. The divide that can exist with people that use AI versus not. The question on countries, by the way, is fascinating. And by the way, Jerry, I took hope for the next forecast, by the way, that California will have disproportionate gain here when you look across the country and look across the world. So question is the time frame, but have hope that California will be terrific here. Let me just say in closing, a big thank you to Mark and Matt. I always learn from you guys. You've done us a great service. Thank you very much, and thanks to the Forecast for including us.
Welcome back, and we are really privileged to have Steve Zakowicz as our keynote today. Steve is President and Chief Executive Officer of the Aerospace Corporation, which is a leading architect for the nation's national security and civil space programs. The Aerospace Corporation has more than 4,000 employees and an annual revenue of $1.1 billion. And Steve is a recognized leader across government, private space, and technology sectors. He served in prominent roles at Virgin, U.S. Department of Energy, NASA, and the White House Office of Management and Budget. And he serves on various boards of both MIT and Cal State Long Beach. Has served on the FAA's Commercial Space Transportation Advisory Commission and co-authored the AIAA International Reference Guide for Space Launch Systems. During his tenure at Virgin, he served as Chief Technology Officer and President of the firm's Space Ventures business. And prior to Virgin, he was Chief Financial Officer of the U.S. Department of Energy, supporting basic scientific research and advanced energy technologies. And then prior to that, Deputy Associate Administrator for the Exploration Systems Mission Directorate at NASA. Let's see, there's much else, and you can read the bio, but we really want to get to the conversation. But Steve earned his bachelor's and master's degrees in aerospace engineering from MIT and has been awarded NASA's Outstanding Leadership Medal and Presidential Distinguished Rank Award. Steve, welcome to UCLA.
Great, thank you, Jerry. Great to be here.
And I think let's start off with maybe you can tell us a bit about the Aerospace Corporation, because I'm not sure everyone is familiar with it.
Okay. First of all, again, Jerry, thank you and UCLA for the opportunity to be here. When I got the invitation, I didn't graduate from UCLA, but my daughter did. And she loves it, and she got me totally into being a Bruins fan. And nowhere did it show more than Kara Fault, the president of USC, invited me to attend the USC-UCLA football game. And little did she realize I was going to bring my daughter in the colors of the Bruins to that game, and they won. So yeah, that was pretty awesome. So the Aerospace Corporation. So we've been around since pretty much the beginning of the aerospace industry. We were actually a spinoff of the old company TRW, and it was driven by the era in which we were in a missile race with the old Soviet Union that developed the first intercontinental ballistic missile. And so we were developed as a deep think laboratory to help enable that. But Congress decided that instead of being part of TRW, we needed to be an independent, nonprofit organization that was there to benefit the government and industry. Missile technology, by any other name, is a rocket. And those early days, we had trouble getting our astronauts in space. And so it was decided early on we needed to use that missile technology to send the first astronauts into space. So we were called upon to help to convert those missiles into rockets. One of my favorite pictures at Aerospace shows some of the famous astronauts from the Mercury and Gemini project. And they're next to these nerds with skinny, thin black ties and so on. And that's the Aerospace Corporation in those pictures. Fast forward over the last 60 years, we have dedicated ourselves to the space domain. That is our expertise. We do things primarily in national security, defense, intelligence. We do a lot on the civilian side. We've done a lot of work with NASA, regulatory agencies, and commercial. As a nonprofit, we're a federally funded R&D center like JPL. So the government uses us because we don't compete with industry, but we work with industry. We're over 3,000 scientists and engineers and exquisite capabilities. And they use us when like a SpaceX or a company has particularly challenging problems that are hard to get to root cause on, or help to connect things and come up with the concepts of where the future is headed, that they'll bring in my company to do that. So we have this sort of very special role, and I would argue no other organization is as connected across all things space as we are fortunate to have at the Aerospace Corporation. So it's fun.
Yeah, so that's a very long trajectory from Atlas rockets to where we
Yep.
are today. So, you know, kind of, can you give us a picture, maybe a overall macro picture of where space
Yeah.
and the space industry is today?
I think you don't have to look any further than this past week. Okay, I don't know if many of you hopefully saw it in the news, but venture-backed commercial company successfully landed a spacecraft on the surface of the moon called Blue Ghost. It was the first time that was done successfully and upright. Before then, only countries like United States, Russia, China, India were the only ones to be able to do it. 2 days from now, another commercial venture-backed company is going to be landing on the moon, and it's going to be carrying other venture-backed efforts, little robots that are going to scurry on the moon, little spacecraft that are going to just thrust its way around the surface of the moon that thing lands. This afternoon, the world's biggest rocket is going to attempt to take off again. Starship by SpaceX is going to be going on. A week ago, another commercial company by Bezos-backed Blue Origin flew people to the edge of space and brought it back. A local company here designed a spacecraft that actually brought back things from space to the surface of Earth to bring it back. And there's another LA-based company who just in the last week launched a spacecraft that's going by the moon, and it's on its way to an asteroid to see if there are critical materials that is worth mining asteroids. That's just in the past week. So it just gives you a sense. It's an incredibly dynamic time right now.
So with all of this going on, is this research and development getting far ahead of the commercialization of it, or are we sort of there? You know, where are we in this regard?
Yeah, I mean, the whole space area has changed a lot just in the last decade. So when I went to school and I graduated from MIT, I thought, you know, it would be fun to have a space startup. So I remember taking classes at the Sloan School and taking things on entrepreneurship. And by the way, this was like in the 1980s, so it dates myself. But back then, startups was like not a thing. In fact, people were looking at me saying, wait, why would you throw away your education and doing a startup? That's pretty risky. Why would you do something like that? Nonetheless, I was pretty excited. So I looked into it and I came to the conclusion that if I could just raise $100 million, I too could have a startup space company. That was then, because things were hard, they were exquisite, it was expensive to fly on a rocket and so on. It just cost 100 million was your entry level to get into it. So fast forward to today. The price of launch has dramatically dropped. I mean, 10x. So you used to be flying the space shuttle. It was, you know, at least $1 billion a launch. You can get a dedicated SpaceX rocket today for, you know, under 100 million. The things we build in space, yes, some of them are still exquisite and very expensive. But now you could, at a university level, for, you know, $100,000, $200,000, build a CubeSat satellite that could fit in my hand, that could actually do useful things in space. And it's a good way to demonstrate early capability that then gets venture-backed and Wall Street funding behind it. So we've just seen the whole economics of space has dramatically changed in the last 10 years. So we have actually launched more satellites in the last few years than in the entire history of the space program across the world. That's how much it has really grown.
So, you know, when I think back to airlines and kind of the beginnings of commercial air transport, so you think in the 1940s and the 1950s, this was pretty exotic. People put on suits and ties and formal dresses to go, you know, fly short distances on DC-3s. And very few people did it, and it was expensive. And now we can't imagine not just getting on an airplane to go someplace for a weekend. Do you see that sort of thing happening with commercial aerospace, commercial space rather?
Well, it's certainly happening with regards to satellites. It's and even rockets. I remember when I started at Virgin, Richard Branson came to me and said, we're going to get some money. We're going to put it into building a rocket, take small satellites to space. And I thought to myself, that was a kind of crazy first meeting. You know, me and NASA will do it or something. But we did. We actually built a rocket. It successfully put small satellites into space. So it's crazy to think about it, but we are a place in the space program that, again, you don't have to be part of a big government operation to do it, that the know-how, the tools to do it are there that can be readily done. Maybe to your question with regards to people, we're not quite there yet, but the fact that I mentioned earlier, a company like Blue Origin or the one I worked at, Virgin Galactic, we offered rides for people to space. You know, I had a friend of mine on the phone. I was just chatting with her and she says, oh, by the way, Steve, before we get off, I just want to let you know, next month I'm going to space. So that's not a usual conversation you have. And it was because she was going to fly in a Virgin Galactic flight. It's expensive. And I think that the early days of commercial aviation was the same thing, right? It was really
Exactly.
for high net worth individuals that would fly transatlantic was completely exotic to be doing something like that. So we're at that place right now too. So it is hundreds of thousands of dollars. So it's for people who can do that. But I do see at time, just like all technologies, as we fly more, get up rates, I could see costs getting down to tens of thousands of dollars. I know when I was at Galactic, we assessed the market, like what would it be? And the sense was if you could get in the tens of thousands of dollars, still not cheap, but then suddenly it really opens up to a lot more people who are saying, you know, I go on exotic vacations for, you know, $20,000, $30,000.
Right.
Maybe this is something I can do. So that could really see a major change on it. And again, that's just for short visits to space. We're seeing like stuff like SpaceX has done, where people can go to orbit, people can go to the space station. Again, expensive, but I will tell you, as a kid, there was a movie, 2001: Space Odyssey.
Sure, of course.
Classic. Anybody movie? Yes, it's fantastic. So there's a scene that always struck with me, which was, it was Pan Am, which was the airlines of the time. They had a space line in that were shuttling people between the moon and Earth. And I thought, that's the future I want to live in. So honestly, besides the Apollo moon landing, which was very inspirational, that movie actually got me thinking, this is the future I want to live in.
So it's too early to buy my ticket to the moon, but not, but it's coming.
Yeah. It's coming. It's definitely coming.
So let's talk about some other aspects of space exploration and the development of this industry. And you mentioned mining of asteroids and maybe the possibility of identifying things like wildfires. We talked about wildfires earlier in the program. Kind of what are sort of the things that you see coming out of this kind of major developments that space exploration and the development of the space industry are going to be leading to?
Yeah, you know, it's an interesting thing we talk about in the industry is we have an event that we used to do, we called A Day Without Space. And the reason why we even talked about that is space is in your daily lives. You don't think about it, you know. The GPS satellite, which is actually something the Aerospace Corporation, we helped to co-invent. And it was driven at the time based upon the Vietnam War and the need to have better navigation for our bombers and missiles and so on. But we came up with an architecture that allowed it to be used globally. And now we see the price points down and now everybody has it in their iPhone. And, you know, I've heard that, you know, the classic conversation, like, you know, I don't need a satellite because I can do it in my phone here. But they don't realize it. It's obviously, whether it's your phone, whether it's the financial systems, whether it's your vehicles, it's just ubiquitous in our lives. Communications used to be a big deal when you would remember long distance calls, remember the special charges. Now anybody you can call anywhere, anytime, enabled by commercial communications. Weather satellites are incredibly sophisticated as we go forward. Communications, Starlink satellites has really upended the whole industry, the ability to just very inexpensively, whether you're in a war zone or a disaster zone, to be able to do these things. A direct to a device. I mean, Apple introduced a year ago, you can do 911 anywhere in the world from your phone if you need help. And now it's going beyond just a help call, but you could do text, voice, and pretty soon you're going to be able to just do it anywhere with these new, using satellites, directly talking to your phone, doing away with cell towers. Things that we could do in space, laboratories, there's a lot of exquisite research that in the absence of gravity could enable new pharmaceuticals and new applications in that regard. Power from space is one of the things that's always been talked about. The idea of using, again, the energy of the sun with big solar collectors and beaming it through microwaves down to the surface of the earth is a way to get clean energy. So there's quite a few things that are going on now and just around the corner that I think is quite exciting.
Some of the things that we used to read about in science fiction novels are
Yes,
coming to play. So, we talked earlier in the program when we were speaking about our economic outlook about all of the change priorities that we're seeing in Washington. How do you see that affecting aerospace in general?
Well, I mean, generally speaking, this administration has been very supportive of national security, the importance of defense. We'll see how things play out. There's been discussions about enhancing the level of investment that goes into national security writ large. There's a lot of interest in the administration with space. I think space has really become one of the most exciting industries that's going on for the reasons I've articulated. And it's not only a good tool for the applications, but it's also a good tool of diplomacy and opportunities for international cooperation, as we have demonstrated in the past. Now, the thing that has been talked quite a bit about the new administration is this new missile defense capability. That's been now given the name of the Golden Dome.
As opposed to the
Iron Dome, yes.
Of course.
So, but again, the idea for those of you who haven't been paying attention to it, it's a missile defense for the entire United States. Because our adversaries are getting really good at new kinds of technologies, missiles, hypersonics, cruise missiles, drones, to undertake attacks. And so the idea was to try to create that. To tie back to space is going to be a critical element that'll enable that kind of continental US defense system as we go forward. And this new administration has been very much on issues of streamlining, whether it's regulatory or how the United States goes about buying things. So if you look at the kind of people they're putting into positions, a lot of them are coming from the investment community with the kind of a background, Silicon Valley, to sort of say, how can we go about it very differently and speed up the need to buy things, which to me is really important, because one of the things that I think is driving national security these days is what we're seeing out of China. Things that we used to have a tremendous lead on, like the space program, we don't anymore. I mean, China has sent robots to the moon, brought samples back, landed on Mars. They have their own space station. They're sending up astronauts. They have their own GPS. They're mimicking a lot of our launch capabilities as we go forward in proliferated constellations. And they're moving ahead, whether it's AI or quantum and other things that either, they're catching up or surpassing us on. So we need to move much faster than we've had in the past. In the old days, you used to put up a satellite in space and you could say, I'll put it up there and it'll be up there in 10, 20, 30 years and no one will touch it. In the last 10 or 15 years, nations such as China have demonstrated the ability to send a missile or disrupt through other means your satellite capability. And so space is now being talked about as a warfighting place. It's, like I said, Star Wars is no longer just a movie. It's actually the world that we're living in. So what does that meant for us? We no longer have the luxury of saying, let's design something that'll last 30 years. It's now, we need to design something that's maybe good for 2 to 4 years. That means we got to move much faster and build a much more resilient capability so that there's no one simple way to knock out our capability. So today, just as an example, GPS satellites, as important as I talked about it, but if you're anywhere around Ukraine or that part of the world or in the Middle East, your GPS is going to go haywire. That's a problem. Both economically, it's a problem, but also militarily, it's a problem. So we can't just put up these satellites, these few dozen satellites we've had in the past. We have to come up with much more resilient, capable ways to ensure that even in hostile environments, that things can continue to operate.
So it sounds like this is a real growth area, and we have a large aerospace industry here in Los Angeles and in particular, but Southern California in general. Why is it that we have that here? I mean, we always hear about California being so business unfriendly. What's the reason why we have that and we have so many startups here?
Let's start with history. I mean, just what I said in the beginning, the ICBM, it was General Schriever here at the LA Air Force Base, who was the father of the ICBM, and why we have the Aerospace Corporation and Northrop here and a lot of the other major companies here. So we've had a long history through, including World War II on the aviation side in terms of things that we have done. I think what has really kept it here, even though there's certainly some challenges right now going on we could speak to, but what I think has kept it here foremost has just been the talent that we see in Southern California, driven by the schools that are around here, driven by places like aerospace and JPL. So I know when I was at Virgin, we seriously, and I was given the role of looking throughout the United States, where should we base our operations? And there are other states and other places that are attractive, but the number one reason was the talent is here. So we see that now. So like as SpaceX, as an example, has grown, a lot of people have left that company, but they've also started up their own companies. And those companies have also spun off, individuals have started their own companies. And so like where my company is in El Segundo, that has become like a little bit of a Silicon Valley for space, where you got a lot of these small startup space companies who get their seed funding there. And then as they grow, they move to Torrance and Redondo and Long Beach and Mojave. And so I think it's really been driven by the history, the talent, and the opportunities that are in this ecosystem.
So you don't see this industry moving to Denver or South Texas or elsewhere?
It could. It's the thing. I think it would be a mistake for the state in Southern California just to take for granted that because it's always been here, it will always stay here. I mean, there are clearly some challenges, ones that I remember I had to deal with when I was at Virgin was just the regulatory environment. We wanted to do testing. We wanted to do it in Mojave. It's a great place to actually do rocket engine testing. But there was so much paperwork involved in it. It really made things challenging. I remember one report we had to turn in. It was on dust mitigation for our rocket engine test, which we thought was kind of crazy ironic because we're in a desert. We have sandstorms all the time. So, right, I'm not sure what we were contributing to that other than you didn't want to make sure it's nothing hazardous. Just sort of things like that has sort of driven companies to begin to look elsewhere. So I wouldn't take it for granted. I think there are some things that the public officials have to pay attention to make sure that it stays here and it continues to thrive here.
And in addition to the regulatory environment, what else should California be doing to kind of solidify the growth in this industry in Southern California?
Yeah, so again, we have a lot of the talent here. And then one thing that I don't know how you fix it, but the cost of living here is higher than other places. The cost of housing is higher than other places. In this post-COVID era where people don't like to commute anymore for an hour and a half, but yet for the kind of work we often do, we need to have people to come in. It has required us to think a little more expansively. So are there places in Orange County, for example, where Anduril stood up its operations to go and build out things there? So are there places, whether it's on the periphery of, let's say, some of these urban areas or inside these urban areas? So like I said, I think the El Segundo model is actually a really great one to sort of create a place that seeds these companies and then they sort of move, hopefully, staying in the Southern California area. So I think there is an importance to have a very proactive public-private partnership effort to try to attack the talent. Going back to just my Virgin experience, another thing that was a tipping point for me was Mayor Garcia when he was mayor of Long Beach. I remember meeting with him and he said, we will move expeditiously to enable you to set up here in Long Beach. And that was actually a pretty major tipping point for me, why we decided to put our facility in Long Beach. Fast forward to today, we were the first space company to set up there. There's now a whole string of space companies in the Long Beach area with significant facilities in production and manufacturing that as a result there. So I think that's sort of a good example of a pro-business environment that allows these companies to stay.
And you mentioned that the talent is here. And so workforce development is always the subject that comes up here in California. Are there things that the state or the local government should be doing in workforce development to ensure that we still have this deep pool of talent?
Yes. I mean,
this isn't a plug for UCLA.
Yes. And there are great schools. There is UCLA and USC and Caltech and the Cal State schools that are in the area. And again, it's everything from, advanced degrees to we need technicians on the floor to help do some of these, some of the production. So it's to help with some of the craftsman effort that takes place, but encouragement from the state to have, the students with advanced degrees to want to come here, stay here, live here, I think is really important. Opportunities for scholarship, something that I know that we at Aerospace have been very proactive on. I personally have been very proactive on is trying to get students tied in with industry through internships and fellowship programs and so on. So again, not only are they having their education here, they're making the connection to the local companies. So it makes it easier for them to get their first job, but also gives them the reason why they want to stay here longer term.
Yeah, is there a role for our community colleges in this?
Oh, absolutely. That goes back to the technicians that I was talking
Mhm.
about, for production capability. And again, it's not just a question of someone who's good on a machine tool anymore, but it's someone who can operate some of these advanced manufacturing machines and be able to work with
Mhm.
computers and feeling very comfortable with it is in very high demand.
So I remember back in the Mercury, Gemini,
Yes.
Apollo programs, there were a lot of spillovers of things that had to be invented that ended up being sort of not associated with space exploration, but commercialized. Are you still seeing that? And are you seeing that develop in the ecosystem here in Southern California?
Yes, we have. I mean, again, I think some of the advanced capabilities that we, for example, demonstrate on the manufacturing floor for these space companies are now starting to spill over to other industries. I think Elon Musk is sort of an interesting example. So he's taken both Tesla and SpaceX and made it a bit of a synergistic relationship between the knowledge that SpaceX has on being able to design very exquisite, very detailed, really hard technical problems with the production savvy of Tesla. So, he has brought that production capability to SpaceX and brought the R&D know-how of SpaceX, to Tesla. I think sort of creating those kind of ecosystems where those things are being shared is really important. As we enter a world where we'll see how things play out, but with talks of tariffs and so on, and the desire to bring more manufacturing capability here, I think that's now more important than ever. Things that I know at Aerospace, we talk with the government a lot about. It's no longer just these companies that we all think about, the Boeings, Lockheed, SpaceX, but it's the supply chain below them that is really important. As a nation, we need to rebuild. China is exquisitely good at being able to take something on a blueprint and manufacture it quickly. We're not. So things, I gave a talk recently and a student said, what do I recommend for a startup in space? I said, build valves. And it got a laugh from the audience, but I was actually dead serious. Something as simple as a valve, which is super important for rockets, it doesn't work without them, is a really hard problem. And it's super expensive, and we're really not good at it. And if there was someone out there who could actually do something as basic as that, that is actually a very profitable business. And so I think the more we can encourage that kind of basic capability, whether it's aviation, space, automotive, I think could be a very lucrative area for the area.
So why is China good at this and we're not?
Yeah, that would take a longer conversation, but I think part of it is, just under opening up markets with regards to like production and manufacturing, it always tended to go where you could find the cheapest labor. So that's why things had tended to leave this area and even out of the US. And I was just reading, it's a great book I just finished called Chip Wars by Chris Miller.
Mhm.
Talks about the chips that were manufactured in this country, how it all started here, but over time it migrated to now it's Taiwan that sort of dominates it, and Singapore and Korea, and now again we're trying to bring that back because we realize that again, should we get into a conflict in the Pacific, we're in a bad place because we are so dependent. So whereas Apple will come up with these great products, but then they'll send it overseas to manufacture it. So I think a challenge for us is not only how do we bring it here, but how do we bring it using advanced manufacturing techniques? Because it's, again, if you're trying to compete dollar for dollar in labor, I think we'll lose. But if you bring it on, the kind of automation, robotics capabilities that I think we can bring to the problem, which by the way is a lot of the companies that are springing up in that El Segundo area are ones that are kind of focused on that very problem. How to get more flexible, capable manufacturing that can potentially reduce the cost and bring it here in the US.
So we've talked a bit about the large aerospace industry here, and it's growing and more or less staying here, but you all moved your headquarters. So maybe you could talk a bit about that and what that decision was about, and is the rest of the aerospace corporation moving?
Yeah, so I think it's almost a misnomer. I think there was a time when people would say, I'm moving my headquarters, that actually had significance in jobs and the factories that would follow it. I think that era is not true anymore. We moved our headquarters. Why? Because a lot of the decision makers and our customers are in Washington, D.C. You know how many jobs we moved as a result? 0. Because we already had people there. You don't have to sometimes be physically present. And a headquarters to me is nothing more than a place. It's a legal place where you put your flag and maybe the CEO hangs out there. So it used to be a time like when Northrop Grumman moved from here to Northern Virginia. That was a big deal. That was many hundreds of jobs. Today, you get companies like Boeing, Raytheon, Aerospace Corporation move headquarters. There's almost no change in people. So I don't think that's really as much of a concern. I think maybe what was more important was we had committed to spend over $100 million of renovating our technology campus here in El Segundo to modernize it for the kind of challenges that we're seeing. And so we are hiring quite a bit. There's a lot of opportunity right here local because of the things that we're doing. I think that's the kind of thing that is should be paid attention to.
Right. That's more significant than
Much more.
Than renting some office space.
Exactly.
And my old company, the Boeing company,
Yes.
people think their headquarters is in Arlington, Virginia, but all of the executives are still in Seattle.
Yeah.
Okay, so we teach MBAs here.
Yes.
What advice would you have for our MBAs?
I don't want to be overly generic, but I always feel when students say, should I go on to get an MBA? I always try to encourage, like, for what purpose? Is there something that you specifically want to apply it to? So again, everyone's different. So this is not I don't think a cookie cutter answer, but to the extent that you can find an industry or a kind of application that you want to apply this a degree to, I think that's the best place to be. I sort of encourage students that before you jump in to get an MBA, maybe go out and work a little bit, get exposure, see what you like, see what you don't like, see if you go get your MBA, what you want to apply to.
And work in space exploration, right?
And if you haven't done that, if there's MBA students who haven't done that, it's not too late to use your summer break to, again, try to find those opportunities to see how you might be applied and how you might want to use it as you go forward.
Yeah, excellent advice. We have a couple of minutes for questions. Do we have any questions from the audience? We have one over here.
You mentioned the Iron Dome in Israel. And of course, President Trump's talking about the Golden Dome, and we need to create one. And so I think the thing that I'm thinking about here is the Iron Dome was not fully successful in stopping missiles coming through. So we had to loan them THAAD, right? And so that for extra protection. We have multiple different nodes here, like Mattis and that, and so on and so forth. But how do you see, well, I believe that they're going to try and tie all these nodes together and then run them with AI. I mean, that to me seems like what I'm thinking that they're going to try and do. And if that's the case, if that's what they are thinking of doing, how long would it take for that to become operational and to provide full defense for the United States over and beyond what we have on the ground?
Yeah, there's a lot loaded into that question. For the sake of the audience here, we have a missile defense capability today. And again, what we designed it for, we were worried about like rogue nations like North Korea who can have missile technology. And if they shot 3 or 4 missiles at the United States, we'd have the ability to shoot it down. What the Golden Dome is trying to do is saying, all right, take the example of Iran and Israel. Iran launched 300 projectiles at Israel all at once. That was overwhelming. And by and large, Israel, with help of allies, took them all down. And so the vision is to try to do something like that. It's going to take a while to do that, and this administration recognizes it. So that's why they want to do it in phases. On your question of AI is actually an interesting one. I mean, one of the things we're learning in the days where like one missile would come from Iraq and it would be heading over to Israel, and we'd have a Patriot battery. You'd have the operator who would say, yep, I see it. It's on radar. Push the button, shoot it down. In the era where there's 300 being shot at you all at once, you can't actually have operators. You are having to rely on the machine to start to do it. Now, the United States is pretty strongly in the position of saying, at the end of the day, it still should be a human operator that gives the go. But we are having to work on tools that say, all right, what do you do when this all comes at you at once? We are thinking about that at aerospace from space warfighting. So as we have satellites in space, it's one thing to have one missile coming at you and say, what do I do? But what if you do have a whole salvo of things coming at you all at once in multiple locations? You really do need the machines in there to come in and say, here's your options. You got 90 seconds to decide, what do you want me to do? So we are quickly having to pivot in that direction.
Okay, we have time for one more question. Yes, yes, Sebastian.
Yeah. You mentioned that one of the handicaps of Southern California is the cost of living for potential employees. And this is what I'm interested in. And then you said, for what you do, you need people to be together.
Mhm.
What's your company's policy on working from home? I mean, are you stopped it? How are you doing it? 4 days a week, or how?
Yeah, it is a super hard problem, right? I mean, everyone knows this. During COVID, we said, hey, we're all flexible, work from home. And then I think we've discovered over time, yes, it is a new tool to be a little more flexible, but it kind of went a little too far over. At the end of the day, I feel like we were living off pre-existing relationships. Like if I knew you and you know me, yeah, we could do it over the phone. But if we're two strangers, it's hard to come up with innovations and passing on the culture of a company with just a group of strangers, sharing Teams or Zoom. So like other companies, we've said, all right, folks, you need to come back to the office much more often. It doesn't have to necessarily be 100%, but much more often. We do need a critical mass of folks coming forward. So I talked about the 100 million that we're investing. It's not just, let's just paint our buildings. We're giving a lot of thought to this. What would encourage people to want to come into the office? So we actually hired someone who came from Disney, who was sort of thinking about what is the kind of environment that will allow people to cooperate, but yet give them a sense of privacy. It's not just open and cubicles, but it would be sort of an attractive place to come in. Compounded by the fact that we have different generations of folks. People that are more my age, they want my own office. I can put my picture of my family, and then and then there's our early career folks. They're used to Starbucks and just putting on a headset and doing it. You have to accommodate all that in doing that. So we actually have put a lot of thought exactly, how you would do this and how you sort of create a campus environment like UCLA, where people are seeing each other over coffee, exchanging information, leaning over, coming up with innovations. So you actually have to work really hard to not just say you have to come to work. That only works up to a point, but they want to come back into work. And so we try to create these sort of purposeful kind of activities on the campus where people would say, yeah, actually, I want to come into work and see my colleagues. It's a hard problem.
So it looks like we're close out of our time, or just out of our time. But Steve, thank you so much for coming
Absolutely.
to UCLA
Thank you.
and sharing these insights with us.
Thank you, Jerry, and go Bruins.
Next time, sit on our side.
Okay.
And before you all leave, two announcements. Our next program here on campus is on the 18th of June. And we will maybe have more clarity about national economic policy, remains to be seen. And we have an Orange County conference coming up at the end of April. And the second announcement, I really want to thank our sponsors again. We could not do this without you all. At the principal level, RSM and Yamava Resort and Casino at San Manuel. At the platinum level, law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, Avenue Insights and Analytics, Bank of California, California Steel Industries, Hub International, Leap Development, PNC Bank, and Robert Half. The silver level, Comerica Wealth Management, Marsh McClellan Agency, US Bank Private Wealth Management, Wilmington Trust. At the bronze level, Accutives Security, HDR, and Shawmut Design and Construction. And it bears repeating, if you didn't hear your company's name, we would love to fix that. So thank you. Drive safe.